This training by the Provider Finance Department provides an overview of cost reporting for providers. Let's begin with the course objectives. After this lesson, you will be able to define what a Medicaid or non-Medicaid cost report is, explain why cost reporting is important, and understand how the cost report process works and your involvement in it. What are cost reports? The purpose of a cost report is to gather financial and statistical information for the Texas Health and Human Services Commission, HHSC, to support reimbursement rate methodology and the development of reimbursement rates. Cost reports are critical tools for ensuring financial transparency and informed decision-making within healthcare financing. Title I of the Texas Administrative Code, TAC, Chapter 355, Rule 105, states that each provider must submit financial and statistical information on cost report forms. The cost reports must be prepared to reflect the activities of the provider while delivering contracted services during the fiscal year specified by the cost report. In other words, a cost report documents a provider's expenditures related to providing healthcare services. Cost reports may include information such as accounting records, invoices, organizational charts, functional job descriptions, other written statements, and direct interviews with staff. Title I, TAC Chapter 355, Rule 105. In summary, cost reports play a fundamental role in sustaining financial integrity and operational accountability throughout the Medicaid reimbursement rate setting process. Why are cost reports important? Cost reports are a key source of data that HHSC uses to both provide information to the Texas State Legislature and to inform Medicaid reimbursement rates. Therefore, accurate cost reporting impacts future rate determination. The Provider Finance Department, PFD, at HHSC uses the data on submitted cost reports to conduct cost and rate analyses. This data helps to support the determination of new service rates and provides justification for adjustments to existing rates. In addition, cost report data enables comparisons between services or across similar programs. For some programs, such as SHARS, School Health and Related Services, or PHP-CCP, Public Health Provider Charity Care Program, providers receive cost settlements based on the data that is included in the submitted cost reports. If the cost reports are inaccurate, providers may not receive appropriate reimbursement for the services that they provide. In addition to rate setting, cost reports support compliance with federal and state regulations and/or requirements. The data is used for public transparency, legislative reporting, and ongoing research. Because of this, cost reports can influence future program structure. Who must submit cost reports? HHSC collects cost reports from a variety of providers and organizations, such as hospitals, acute care providers, long-term services and supports providers, school districts, and foster care system providers. You can find a full list of programs and collection cycles on the Provider Finance website at https://pfd.hhs.texas.gov/pfd-cost-report-information. The cost reporting process. First, providers gather data regarding their expenditures and services provided, then submit cost reports to the PFD. Next, the PFD validates the accuracy of the reported costs to ensure that the data reflects actual expenditures and services. Finally, the information from the cost reports is used to set appropriate reimbursement rates. Preparing and submitting cost reports. Each provider must assign at least one preparer who will be responsible for completing the entity's cost report. Preparers create and submit cost reports through an online application called STEPS, State of Texas Electronic Provider System. The primary entity contact, PEC, financial contact, FC, primary and secondary, and cost report preparer contact, primary and secondary, must complete the required state-sponsored web-based training for each program requiring a cost report before they can either prepare, take an action on, or certify the applicable cost report. Cost report review. Once submitted through the online application, each cost report goes through a financial examination to validate the accuracy of reported costs. The cost reports are reviewed and evaluated based on the agreements with providers, identifying any discrepancies or disagreements within. How the review process works. Submission verification. Reports are initially reviewed for completeness, ensuring that all required documentation is provided. Data validation. Analysts check for inconsistencies, missing information, and unusual expense patterns. Comparative analysis. Costs are compared against historical data, industry benchmarks, and similar provider reports. Provider follow-up. If discrepancies are found or clarifications are needed, providers are contacted for additional information or adjustments. Final approval and documentation. Once all concerns are addressed, reports are finalized and stored for future reference in funding decisions and audits. Key takeaways. A cost report documents a provider's expenditures related to providing healthcare services. Cost reports are utilized to support reimbursement rate methodology. Accurate data and information on cost reports ensure that HHSC has accurate and sufficient data to determine the methodological reimbursement rates for the applicable services. Primary entity contacts, financial contacts, and cost report preparers must all complete the required training modules before preparing cost reports. Thank you. This concludes Module 1's discussion of cost reporting for providers. This training provides an overview of the State of Texas Electronic Provider System, STEPS, and the roles and responsibilities of the system users. Course objectives. By the end of this lesson, participants will be able to define the STEPS system and describe its core functions, identify the different types of STEPS users and explain their roles and responsibilities, understand the training requirements needed to complete the cost report, navigate key user functions within the STEPS system confidently. Next, we begin this lesson with a comprehensive overview of the STEPS system. STEPS is a new software application designed to collect essential information from providers. Beginning in early 2026, STEPS will fully replace the current STARS system. This web-based system will manage a wide range of data, including cost reports and enrollment applications. Providers will find STEPS user-friendly, making information submission more efficient. This transition marks a significant upgrade in how providers manage their reporting processes. Next, let's discuss the account user roles in the STEPS system. System user roles 1 of 4. Access to STEPS will depend on specific role assignments within the system. Role assignments include Primary Entity Contact, PEC, Financial Contact, FC, and Cost Report Preparer contacts. Primary and secondary contacts may be applied to financial contacts and cost report preparer contacts. System user roles 2 of 4. The primary entity contact is linked to the entity's national provider identifier. To ensure accurate reporting, the correct email address must be associated with the National Provider Identifier in Texas Medicaid and Healthcare Partnership, TMHP, Provider Enrollment and Management System, PEMS. The cost reports require the accurate identification of the primary entity contact's email. Validated emails facilitate communication and the proper management of program enrollments and updates. System user roles 3 of 4. Primary entity contact, PEC, identification. The Department of Family and Protective Services, DFPS, determines the PEC for non-Medicaid cost reports, specifically for contracted providers. DFPS provides HHSC with PEC details associated with 24-hour residential childcare, 24 RCC services, and single-source continuum contractors, SSCCs. System user roles 4 of 4. Policy and requirements. The primary entity contact must have legal authority to make decisions on behalf of the entity. Both the primary entity contact and financial contact must be authorized decision makers for the entity. The assigned cost report preparer is selected by either the primary entity contact or the financial contact and must complete the required cost report training. Now that we have identified the user roles in STEPS, next we will discuss the link between your PEMS and STEPS accounts. STEPS System Access PEMS account, All Medicaid providers must verify their PEMS contact information for accurate communication. Regularly verifying your PEMS email ensures you receive important steps, updates, and notifications regarding account registration and other relevant information. Providers enrolled in PEMS are responsible for keeping their contact details up to date. Updating information in PEMS. 1 of 3. Providers must regularly check PEMS to ensure all information is accurate and up to date. To maintain current data, start by logging into TMHP PEMS and accessing your provider enrollment record. Review all sections carefully, including names, phone numbers, and mailing addresses, ensuring each detail is accurate and up to date. Regular updates help ensure effective communication with providers. Updating information in PEMS. 2 of 3. For detailed instructions, visit the THMP PEMS website. Once on the site, locate the Provider Enrollment section at the top of the page and select the Instructional Site option. Select Maintenance from the drop-down list. Then, follow the prompts to view or edit the provider information. Instructions for updating information in PEMS are provided on the HHSC STEPS Transition website in the STEPS Transition Guide, System Access on page 5. Free web-based training will be accessible within the STEPS system for users. Each training module is organized by cost report program, year, and topic for easier navigation. Users will learn how to complete cost reports effectively in the STEPS system. Specific training units will focus on essential topics, such as allowable costs and depreciation, for clarity. Users can adjust their training to a learning pace that suits them. Training. General information. 2 of 3. Each STEPS user must understand the specific training requirements for their assigned role. Providers must complete the state-sponsored training modules before submitting any cost reports. Both the PEC and FC must complete the web-based training to ensure proper report preparation and compliance with state regulations. It is important to note that training requirements vary by role, so users should regularly review the required updates to ensure compliance. Cost report preparers must finish training before being listed on STEPS. The PEC or FC is responsible for assigning preparers to their specific cost reports once they have fulfilled their training requirements successfully. Cost report preparers must complete state-sponsored web-based training. Only after the training is complete can the PEC or FC designate the appropriate cost report preparer for the assigned report. Now that you have a better understanding of the cost report training expectations, next, we will discuss the credits earned for training. Cost report training credit. Training credit is applied by the cost report program and year. Once training is complete, the credit awarded remains valid for that cost report program and year. To access a different cost report program or year, you must complete the training specific to that program and year. Example, to access the 2025 CPC cost report in STEPS, you must first complete the 2025 CPC cost report training. STEPS user roles and responsibilities. This slide presents a table outlining the STEPS user roles and the permissions associated with each role. The table identifies which users are authorized to perform key system actions, including assigning user roles, preparing or editing cost reports, certifying cost reports as a preparer, certifying cost reports as an entity representative, agreeing or disagreeing with adjustments made during the examination process, and submitting an informal review when disagreeing with adjustments. The first column lists each system role, while the remaining 6 columns indicate whether the user is assigned to that role and whether they can perform each action. Some permissions require completion of the applicable cost report training module. Providers are responsible for understanding STEPS, user roles, and permissions. Before using the STEPS system, please review this information carefully. This concludes Module 2's discussion of the new STEPS, State of Texas Electronic Provider System, overview. Module 3 of the Cost Report Foundational Requirements provides information on the following types of costs: allowable, unallowable, billable, non-billable, and reported costs, which are itemized on the cost report. To begin this lesson, we will identify the purpose of documenting allowable costs on the cost report. In accordance with TAC Rules Section 355.102A, PFD collects allowable costs to comply with established regulatory guidelines. Adherence to Section 1902A-30 of the Social Security Act requires that payments for services prioritize efficiency, economy, and the quality of care. Allowable costs serve as a framework for identifying expenses essential to providing contracted client care in a responsible manner. By identifying allowable costs, PFD ensures that expenses deemed reasonable and necessary directly support the provision of contracted client care. Now that we have identified the purpose of allowable costs, next we will review key terms to enhance your understanding of this important topic. According to 1 TAC Section 355.102F1, the term reasonable refers to the amount expended, emphasizing that providers must strive to minimize costs while ensuring expenditures remain within the limits of what a prudent buyer would pay. Moreover, 1 TAC Section 355.102F2 defines necessary as the relationship between costs incurred by a provider and their relevance to the delivery of contracted client care. Necessary costs include both appropriate direct and indirect expenses that are essential for maintaining the required standards of operation as stipulated by contracts and state and federal regulations. Together, these definitions guide providers in ensuring that both the costs incurred and the services rendered align with prudent financial practices and regulatory compliance. The next several slides provide an overview of the most common examples of allowable costs. This section outlines the various components of employee compensation. Different types of costs for employee compensation include regular salaries and wages for staff, overtime pay, and non-hourly earnings like bonuses that are subject to Federal Insurance Contribution Act, FICA, and Medicare taxes. Payroll taxes, such as FICA, workers, compensation paid claims, and unemployment compensation, are recognized as allowable costs associated with employee compensation. Additionally, certain employee benefits, which are not subject to FICA and Medicare taxes, are also classified as allowable expenses. For contracted staff, compensation is categorized differently, as these payments are typically gross amounts paid directly to the workers without any employee deductions applied, such as for 1099 employees. Understanding these categories of allowable costs is crucial for ensuring compliance with federal regulations and accurate financial reporting. Let's continue defining key terms. For supporting documentation of employee compensation, providers are required to maintain comprehensive records that clearly identifies each type of compensation received by their employees. Essential paperwork includes payroll documentation, which details hours worked, reflecting both regular and overtime wages paid to employees. Additionally, providers must keep records of all insurance policies and benefit policies that outline employee coverage and entitlements. Documentation must also encompass records of paid leave, showing both the amount accrued and the time taken by employees to avoid discrepancies. Now that we've reviewed the supporting documentation for allowable compensation, it is essential to recognize the various types of costs that are categorized as benefits, which add value to the overall employee compensation package. The next two slides provide some examples of the types of costs that are categorized as benefits on the cost report. Let's discuss examples of the different types of costs that must be reported as benefits and directly charged to the individual employee. Retirement funds and pension plans are significant components of an employee's total compensation package, reflecting the employer's commitment to their long-term financial security. Additionally, costs associated with employer-paid health, medical, dental, and disability insurance premiums, as well as paid claims, are vital for providing comprehensive employee care. Employer-paid child daycare services for employees. Children not only support work-life balance, but also represent a valuable benefit worth reporting. Accrued paid days off to employees that have not been used are not yet subject to payroll taxes. Another example of benefits reported as costs includes essential benefits like employer-paid training and/or educational program costs that will need to be reported as specific line items on the cost report, which can include the cost to maintain an employee's professional license or certification. Additionally, uniforms provided to employees should be documented, reflecting their contribution to overall operational costs. Non-cash incentives, along with mileage reimbursements and meals, should be accurately reported in the administrative costs section for transparency and employee benefits. Finally, to support reimbursement claims, all mileage logs and travel allowances provided to employees must be accurately recorded. For more information on costs that are reported as benefits, refer to the TAC Rule 355.103b1. It is important to note that the administrative benefits will be categorized under specific line items in the staff expenses section. Next, we will continue to examine the different types of allowable costs reported on the cost report. Let's review some more examples of allowable costs. Travel costs that are allowable on the cost report include lodging expenses, mileage, and meals reimbursement incurred during business travel. It is important to note that funding for out-of-state staff training is allowable only if the staff training is not available in the state of Texas. Delivering client services is permissible within a 25-mile radius of the Texas border, including neighboring states but excluding Mexico. Finally, out-of-state travel expenses are only allowable for specific programs, such as 24-hour residential childcare, 24 RCC. Insurance costs include those aligned with arm's-length transactions, particularly for commercial carriers, where the insurer must adhere to the standards established by the Texas Department of Insurance. For limited-purpose insurers, the costs of premiums must not surpass those of comparable insurance options available in the market. Special risk management funds, or pools, are required to be managed by a third-party entity that accepts a portion of the associated risks, ensuring financial accountability. Self-insurance occurs when a provider independently assumes the risk for anticipated liabilities, with allowable costs tracked on a cash or claims-paid basis, while partial self-insurance involves shared risk with another entity through mechanisms such as stop-loss policies. For more information, please review TAC 355.103b 12-13. Now that we have a better understanding of allowable costs, let's discuss the specific types of costs that cannot be included in the final cost report. According to 1 TAC Section 355.102g, unallowable costs are explicitly defined as expenses that do not meet the criteria of being reasonable or necessary. These unallowable costs are reported in a separate section of the cost report submitted by providers. Providers may incur such expenses in the course of their operations, but they are not eligible for reimbursement. Providers must differentiate between allowable and unallowable costs to ensure compliance with state regulations. Ultimately, unallowable costs cannot factor into the Health and Human Services Commission's HHSC rate determination process. Coming up, we will review examples of unallowable costs. According to TAC, Section 355.102g, government fines, which encompass penalties for breaches of various regulations, statutes, and ordinances, are excluded from allowable costs. Fines and penalties or charges incurred due to late payments on taxes, utilities, mortgages, or loans, as well as costs related to insufficient banking, are not eligible for inclusion in cost reports. Additionally, insufficient fund fees and parking fines are explicitly excluded from reimbursement as they are considered personal liabilities rather than business expenses. The next example is fundraising and investment management costs. Provider must recognize that salaries for fundraising and investment management are considered unallowable costs, meaning they cannot be included in the cost report. Notably, taxes for which exemptions are available to the contracted provider fall under this category of unallowable costs. Special assessments on land that contribute to capital improvements are also considered unallowable taxes. Pass-through taxes, such as sales tax, do not qualify as allowable costs in the context of contracted services. Furthermore, self-employment taxes are another example of unallowable taxes that must be adhered to according to state regulations. This list is not exhaustive. Refer to TAC Rules 355.102 and 355.103 for detailed guidance on what qualifies as unallowable costs. This concludes the discussion on unallowable costs. In this section, we will continue discussing the various types of costs that providers can report on their cost report and clarify the key distinctions between allowable and unallowable costs. We will specifically examine categories such as outside consultants and contracted services, highlighting which expenses can be charged to funding sources. Additionally, the discussion will cover accounting and financial examination fees, legal services, and the implications of each on budget compliance. Other areas of focus include advertising and public relations, and the treatment of loan interest and staff training expenses in financial reports. Lastly, we will address the classification of taxes, miscellaneous expenses, and dues and contributions to organizations to ensure proper adherence to funding regulations. Let's begin with our first example of allowable versus unallowable costs with outside consultants and contracted services. Allowable compensation for outside consultants must be both reasonable and directly related to the services outlined in the contract. It is essential that all expenses incurred for services from outside vendors are necessary for fulfilling the contracted obligations. Instances of unallowable expenses include costs associated with investment management and public relations activities, as these do not pertain to the contracted services. Proper documentation should accompany claims for consultant fees to ensure they align with the scope of the contracted services. It is essential to evaluate each expense to ensure compliance with the criteria of reasonableness and necessity related to contracted services. Accounting and financial examination costs that are allowable for business purposes typically cover the preparation of essential financial documentation, such as business tax reports and tax returns. Securing professional financial services is considered a permissible expense when these services are utilized for preparing business tax documentation and financial statements. Conversely, certain costs associated with accounting and financial examination practices are deemed unallowable, such as those for personal tax return preparation, which are not related to business operations. Fees incurred from litigation involving a provider and a governmental entity are also classified as unallowable costs in accounting and financial examination. Other non-allowable expenses include the production of annual reports, reports intended for stockholders, and any fees for investment management. Legal services costs that are allowable under Medicaid guidelines include necessary fees incurred to manage the business operations and administer the Medicaid contract effectively. These allowable costs ensure that providers can maintain compliance while delivering essential services. However, legal retainers are classified as unallowable costs, which means they cannot be included in the reimbursement requests. Additionally, any expenses related to litigation between a provider and a governmental entity are also considered unallowable. It is crucial for providers to understand these distinctions in order to avoid incurring costs that cannot be reimbursed. Advertising and public relations costs that are allowable include recruiting essential personnel and advertising efforts aimed at fulfilling statutory or regulatory requirements. For instance, expenses related to telephone directory listings can be allocated as 1/8 of a page. Additionally, advertising that focuses on procuring items necessary for contracted client care is considered an allowable expense. However, costs that are considered unallowable include those aimed at increasing client utilization and any expenses related to the issuance or sale of stock. Business promotional advertising, public relations costs, and the development of logos or company identification also fall into the unallowable category. Loan interest costs that can be considered allowable include reasonable and necessary interest on both current and capital indebtedness incurred by the contracted provider entity. It is essential that loans are made in the name of the contracted provider entity to ensure compliance with financial regulations and guidelines. The proceeds of the loan must be used exclusively for allowable costs to maintain eligibility for funding and avoid potential penalties. Investments made in operations that are not part of the contracted services may not be accepted, as they do not align with allowable use of loan proceeds. Additionally, utilizing interest from unallowable items or building excess working capital through loan proceeds could result in non-compliance with funding requirements. Staff training costs that are allowable encompass essential programs such as cardiopulmonary resuscitation, which equip employees with life-saving skills. On-the-job training is also considered an allowable expense, as it directly contributes to enhancing employee performance in their specific roles. The costs associated with hiring instructors and purchasing training materials necessary for effective learning are likewise covered under allowable expenses. Registration fees for relevant professional development courses can also be included, facilitating growth and compliance in respective job functions. However, costs incurred for training that lacks a direct connection to an employee's job responsibilities are deemed unallowable and cannot be reimbursed. Now let's discuss tax costs. Allowable tax costs for businesses include property taxes, which are expenses related to the ownership of real estate. Franchise taxes, which are fees paid for the right to operate a business in a specific state, also qualify as allowable tax costs. Contributions made towards FICA, which fund Social Security and Medicare, are essential for compliance and can be factored into allowable expenses. Another allowable expense is workers' compensation on paid claims, which provides wage replacement and medical benefits to employees injured on the job. Additionally, federal and state unemployment compensation taxes are considered allowable costs, as they fund unemployment benefits for eligible workers. In contrast, unallowable tax costs include fines and penalties imposed for non-compliance with tax regulations, as they do not contribute to legitimate business expenses. Federal income taxes, as well as excess profit or surplus revenue-based taxes, are categorized as unallowable because they do not directly relate to the cost of producing goods or services. Taxes resulting from refinancing or refunding operations, including property transfer taxes, also fall under the category of unallowable costs. Understanding these unallowable tax costs is crucial for accurate financial reporting. Allowable miscellaneous costs encompass a variety of essential expenses that contribute to a business's growth and sustainability. One important category is employee relations expenses, which help maintain a positive and productive workplace environment. Research and development costs are permissible, as they foster innovation and help companies stay competitive in their respective markets. Organizations can also account for organizational costs as allowable expenses, as these are crucial for maintaining operational efficiency and governance. Lastly, startup costs are recognized as allowable expenses, providing new businesses with the financial support they need during their initial phases. Conversely, bad debts incurred by a business cannot be recovered as allowable costs in contracted services. Any business expenses that are not directly related to the services specified in a contract are considered unallowable. Contributions made as charity or courtesy allowances are typically excluded from allowable costs under federal guidelines. Fines and penalties incurred due to violations of laws or regulations are also not permissible expenses in contractual agreements. Lastly, costs associated with goodwill or in-kind donations do not qualify as allowable expenses under current accounting standards. When considering allowable costs for dues or contributions to organizations, professional organizations, and maintaining professional accreditation are typically recognized as valid expenses. These costs support the ongoing development of knowledge and skills essential for maintaining industry standards and competencies. In contrast, costs associated with lobbying organizations are deemed unallowable, as they do not directly contribute to professional advancement or accreditation. Contributions to civic organizations are also categorized as unallowable, primarily because they focus on community service rather than professional development. Finally, non-professional organizations are excluded from allowable costs, as they do not provide the direct benefits tied to enhancing professional skills or credentials. Organizations must clearly distinguish between allowable and unallowable costs to ensure appropriate budgeting and compliance with regulations. Moving on to the next topic, we will outline the different types of billable costs. According to 1 Tax Section 355.102 F3, Direct costs represent the expenses that are directly chargeable in the context of contracted client services. These costs primarily arise from direct interactions with clients and are categorized as direct costs essential for client care. Billable costs are almost always direct costs. If these direct costs are found to be reasonable, they must be included in the financial reporting for services provided to clients. Billable costs encompass expenses that can be directly billed based on the units of service delivered to individuals receiving care. So, it is crucial to document and report these billable costs accurately, as they are deemed allowable under the guidelines established by HHSC. This section provides information about various types of non-billable costs that can impact your overall financial reporting. Indirect costs, as outlined in 1 Tax Section 355.102 F4, refer to indirect costs that cannot be charged to a specific unit of service. These indirect costs are essential for the overall performance, even though they cannot be directly billed to clients. Some examples of non-billable costs include salaries for administrative personnel, as well as related non-labor expenses. The next slide provides more explanation of non-billable but allowable costs. Non-billable but allowable costs can include essential staff training activities that enhance service delivery and ensure the health and safety of individuals. These training sessions are critical to equipping personnel with the necessary skills to perform their duties effectively. Another example of allowable costs is the time a case manager spends on charting and documentation, which is vital for maintaining compliance and licensing requirements. These activities, although non-billable, contribute significantly to maintaining professional licensing and ensuring quality care. By recognizing these non-billable costs as allowable, organizations can better allocate resources to enhance the quality of care provided to their clients. Next, on a similar note, and to conclude this module, we will discuss non-billable costs as indirect costs. Indirect costs are activities that are not directly client-facing, but are essential for delivering required services or ensuring health and safety. While these expenses are often non-billable, they are allowable and should be reported on the cost report. This distinguishes them from direct costs, which are billable and typically involve direct service to clients. Reductions to costs can occur when other funding sources contribute to allowable costs, including recovery of costs. For example, if an insurance claim were filed and the insurance company made a payment to the provider, the payment would be considered a recovery of costs and should be reported as a reduction to costs. Or a grant is received to cover specific allowable costs, resulting in a reduction of costs. Supporting documentation. Each allocation calculation must be submitted with an allocation summary that includes a description of the numerator and denominator that is coherent in words and numbers to document the various components of each. Each allocated percentage is rounded to at least 2 decimal places. A list of the various cost categories or expense types to be allocated. 100% of the provider's expenses by cost category PFD prefers that the supporting documentation is uploaded in a spreadsheet format, for example, Excel. This concludes our lesson for Module 3. Welcome to Module 4, where we will explore the essential concepts surrounding related party transactions. This training session aims to provide you with a clear understanding of how these transactions can impact the cost report. In this module, you will gain a comprehensive understanding of related party, non-related party, and related party capping. We will start our lesson by defining the term related party. According to 1 Tax Section 355.102I, a contracted provider is considered related if there is a significant association or affiliation with the organization providing services or supplies. This relationship may also involve situations where one party controls or is controlled by the other entity. Immediate family relationships automatically establish a presumption of relatedness through control or ownership when certain significance criteria are met. It should be noted that providers can only report the costs incurred to the related party. Next, we will identify key terms associated with control and ownership. First, it is important to note that when determining if a provider is related to a supplying organization, apply the tests of common ownership and control separately. Control is the ability of a person or organization to directly or indirectly influence the actions or policies of a provider, indicating a significant level of authority and decision-making power. This power can manifest through various means, such as ownership stakes, contractual agreements, or personal relationships that shape the provider's operational framework. The next term, common ownership, refers to a situation where a person holds an ownership or equity interest in both the provider and another organization that has contracted with the provider. Both control and common ownership are key factors in identifying related party relationships, as they can affect the neutrality of transactions. Let's continue with more key terms on related party transactions. Related party definitions include the concept of reasonable, emphasizing that payments for services should reflect standard market rates for similar work. Additionally, the term necessary highlights that the services provided by the related party entity are essential for the organization's operations, suggesting that alternative options would need to be explored if they were unavailable. Ultimately, these definitions serve as a framework to ensure that transactions between related parties are conducted at fair market value. The next term we will discuss is related party compensation. According to 1 Tax Section 355.102I, a related party includes any person or organization connected to the provider through familial relationships such as parents, children, and siblings. The definition extends to in-laws, including mother-in-law and father-in-law, as well as more distant relatives like aunts, uncles, and cousins. Also, any individual or organization that exhibits common ownership or control over the provider may be classified as a related party. Understanding who qualifies as a related party is crucial for maintaining compliance and ensuring transparency in organizational dealings. Please see the cost report instructions and TAC rules for a full list of examples. Next, let's review more definitions associated with related party. Related party compensation must be accompanied by comprehensive supporting documentation that includes a written description of the specific duties, functions, and responsibilities associated with the services provided. It is essential to verify that the services performed are not duplicative, which requires clear differentiation in the work completed by each individual. Daily timesheets or similar record-keeping documents should be maintained to confirm the number of hours worked by the individual receiving compensation. A detailed breakdown of the compensation structure, including regular pay, overtime, bonuses, and benefits, is necessary to ensure transparency. Furthermore, the documentation must include evidence of regular payments, proof of tax obligations, and any allocation worksheets for distributed compensation to ensure compliance and accountability. Now that we have reviewed the supporting documentation required for related party compensation, next let's discuss how to document related party bonuses. When reporting on the cost report, related party bonuses must not be structured as profit-sharing arrangements or determined based on profitability metrics. These bonuses must be clearly defined in a written agreement or established employment policy. Related party bonuses must be awarded without favoritism and should not discriminate in favor of related parties. The bonus policy should clearly define the criteria for bonus distribution, including who is eligible to receive a bonus. Additionally, it must specify the amount awarded to each individual and confirm whether they are classified as a related party. This concludes our discussion on related party bonuses. Next, we review related party benefits. To ensure successful reimbursements, the cost report must include a clearly defined benefits policy that outlines the eligibility criteria for each type of benefit. The policy should specify the individuals eligible to receive each type of benefit, which individuals actually received each type of benefit, and at what amount. Finally, the policy should address whether the individuals receiving benefits are related parties to avoid potential conflicts of interest and maintain compliance. The next topic will discuss related party transactions. A related party transaction occurs when you engage in purchasing or leasing items, services, equipment, or facilities from an individual or organization that has a distinct relationship with your entity. If you obtain a loan from a related party, this transaction is also classified as a related party transaction. Purchases that fall under this category can include tangible items such as inventory or equipment, as well as intangible services like consulting or maintenance. Understanding and documenting related party transactions is crucial for maintaining compliance and ensuring ethical financial practices. In Module 4.1, we covered the terminology and definitions of related party transactions, and in the upcoming Module 4.2, we will explore what constitutes a non-related party. According to TAC 355.102, the relationship between organizations is primarily determined by the elements of common ownership or control. TAC states that if the specified elements of common ownership or control are absent, the two organizations cannot be considered related. Finally, we will conclude Module 4 with a review on related party capping. Now that we have a clear understanding of related party, next, we will examine the Texas Administrative Codes related to related party capping information. Title 1, TAC Section 355.102, defines the essential elements of related party transactions, establishing guidelines to identify relationships that may influence financial dealings. Furthermore, Title 1, TAC Section 355.105, imposes specific limits on related party attendant and administrative staff wages, ensuring expenditures are reasonable and justifiable. Setting an upper compensation limit at the 90th percentile helps ensure costs remain reasonable, and reimbursement rates are both economic and efficient by eliminating profit or markup from related party transactions. See TAC 355.102I4 for more information. This concludes our lesson for Module 4. Welcome to Module 5 of the Cost Report Foundational Requirements, where we will examine approved allocation methods used in cost reporting and determine when allocation is appropriate. The purpose of allocation is to assign indirect costs, many costs, such as facility, administration, and operation expenses, benefit multiple programs or services that cannot be directly costed. To ensure fair and reasonable cost representation, allocation methods provide a standardized way to assign indirect costs to each business component within the entity to accurately represent the true cost of operations for the provision of client care. To comply with regulations, HHSC requires providers to report indirect costs using approved allocation methods in accordance with TAC 355.102J. When applying allocations, it is important to understand that allocation is a method for distributing costs on a pro rata basis among various business components. When multiple business units incur shared costs, it is necessary to proportion these expenses to the corresponding contracts or components that generated them. This process involves dividing shared costs among business components, which may include costs, resources, or responsibilities pertinent to those components. Ultimately, applying allocation techniques helps identify how much of a shared resource or cost should be attributed to each individual business component or contract. For more information, please refer to 1 TAC Section 355.102J. Direct costing must be used whenever reasonably possible and is defined as the costs incurred for the benefit of or directly attributable to a specific business component and must be directly charged to that particular business component. In the next lesson, we will explore the factors that influence when allocation should be made. When direct costing is not reasonable, it is necessary to allocate the shared costs across the business components that received benefits from those costs. Cost allocations determine the total costs attributed to a specific contract or business component when costs are shared across multiple business components. Allocation methods must be a reasonable reflection of the actual business operations and consistently applied across all business components that share the costs. Allocation methods used in the cost report will be reviewed during the financial examination process. The allocated costs may be adjusted if the allocation method is determined to be unreasonable, unacceptable, or has not been approved by HHSC-PFD in writing. An indirect allocation method approved by another department, program, or government entity will not be automatically approved by HHSC. Shared administrative expenses not allocated using an approved allocation method may be returned to the provider for corrections. Now we will review approved allocation methods. On your screen, you will see a table that provides a summary view of approved allocation methods. These allocation methods include units of service, labor costs, cost to cost, salaries, and total cost less facilities cost. If any of these allocation methods are used, the allocation summary must clearly show that the cost components of the allocation method have been used in the allocation calculations. The following pages in this module will provide more details for each allocation method. Now, we will review approved allocation methods for acute care programs to include the School Health and Related Services, SHARS, the Public Health Provider Charity Care Program, PHPCCP, Medicaid Administrative Claiming, MAC, and the Mental Health, Early Childhood Intervention and Individuals with Development Disabilities, MEI. This applies for Hospital Program Cost Report for the Uncompensated Care Ambulance Program. On your screen, you will see a table that provides a summary view of approved allocation methods. These allocation methods include units of service, labor costs, cost to cost, salaries, and total costless facilities cost. Functional and other allocation methods include but are not limited time study of direct services, IEP ratio, specially adapted vehicles, and one-way trip ratio. If any of these allocation methods are used, the allocation summary must clearly show that the cost components of the allocation method have been used in the allocation calculations. The following pages in this module will provide more details for each allocation method. Units of service allocation. The units of service method is the ratio of each contract's units of service, including shared admin costs, to the total units of service. This allocation method must be used for shared costs where the services have equivalent units of the same service. Here is an example of the units of service allocation method. To determine the allocated percentage, the total shared UOS for one facility is divided by the total shared UOS of the entity. For example, the UOS for House 1 $9,961 is divided by the sum of units of service for House 1 and House 2 $17,885, rounded to 2 decimal places, which equals 55.69%. 55.69% is carried up to the shared allocated cost column and multiplied by all shared costs in the shared costs column. Only the shared amount gets multiplied by the percentage. For instance, the total shared cost of the expense type miscellaneous is $346.73. Multiply this total by the House 1's UOS allocation percentage. This will equal the amount $193.09. This amount is entered underneath House 1's allocated shared costs column and in the miscellaneous expense row. Salaries allocation. The salaries allocation method is the ratio of each contract's salaries to the total salaries of all contracts. If allocation based on units of service is unacceptable and all a provider's contracts are labor-intensive, or if all contracts have programmatic or residential building costs, the provider may choose to allocate their indirect shared costs based on salaries. The 2 cost components of the salaries allocation method include salaries/wages, contract labor, excluding consultants. In the cost component above, the term salaries does not include the following costs associated with the salaries or wages of employees: payroll taxes, employee benefits/insurance, workers, compensation paid claims. Next is an example of a salary allocation method. Direct salaries, highlighted in green, for each facility are summed and carried down to the small table highlighted in yellow. To determine the allocated percentage, the total shared salary cost for one facility is divided by the total shared salary cost of the entity. For example, the total salaries for Lake House, $57,033.32, is divided by the sum of salaries for the entity, $249,371.97. The amount is rounded to 2 decimal places, which equals 22.87%. Similar to the units of service allocation, to determine the allocated shared costs, you will multiply the shared costs by the allocated percentage of each business component per expense type. Labor costs allocation. This allocation method can be used when all a provider's contracts are labor-intensive. All contracts have a programmatic or residential building cost, or contracts are mixed, with some being labor-intensive and others having a programmatic building or residential building component. It is calculated based on the ratio of directly charged labor costs for each contract to the total directly charged labor costs for all contracts. The 5 cost components of the labor cost allocation method are salaries and wages, payroll taxes B2, employee benefits and insurance, workers, compensation paid claims, contracted labor excluding consultants. Direct labor costs, highlighted in green, for each facility are summed and carried down to the small table highlighted in yellow. To determine the allocated percentage, the total shared labor cost for one facility is divided by the total shared labor cost of the entity. For example, the total labor costs for NF1, $117,086.27, is divided by the sum of salaries for the entity, $272,752.16. The amount is rounded to 2 decimal places, which equals 43.04%. Just like the previous allocation methods, to determine the allocated shared costs, you will multiply the shared costs by the allocated percentage of each business component per expense type. Cost-to-cost allocation. If allocations based on units of service are unacceptable, and all a provider's contracts are labor-intensive, or if all contracts have programmatic or residential building costs, the provider may choose to allocate their indirect shared costs on a cost-to-cost basis. This allocation method involves a ratio of each of the directly charged costs to the total of these costs. The cost components of this method are indirect shared costs. Examples include utilities, maintenance of equipment, miscellaneous supplies, salaries, and administrative expenses. This allocation method involves a ratio of each of the directly charged costs to the total of these costs. For the cost-to-cost allocation method, the cost report preparer needs to provide documentation that all allowable facility and operating costs were included in the allocation calculations. The table includes expenses such as salaries, FICA, Medicare, utilities, etc. The columns include total costs, disallowed costs, and direct costs, including NF, class, and PHC. The business component of NF in green is summed to $117,955.83, then divided by the sum of all the green, which is $284,396.53, and equals 41.48% in allocated shared costs, highlighted in yellow. For PHP-CCP cost reports, cost-to-cost ratio is called cost-to-charge ratio. A provider's reported costs are allocated to the Medicaid program based on a cost-to-charge ratio. The cost-to-charge ratio is calculated as the total allowable cost reported for the service period as the numerator over the billed charges of all claims for the service period, as the numerator over the billed charges of all claims for the service period as the denominator. This ratio is applied by multiplying by the total charges of charity care claims to get the total allowable cost for charity care for the cost report. For UC ambulance cost reports, cost-to-cost ratio is called cost-to-charge ratio. A provider's reported costs are allocated to the Medicaid program based on a cost-to-charge ratio. The cost-to-charge ratio is calculated as the total allowable cost reported for the service period as the numerator over the total billed charges for the service period as the denominator. This ratio is used in the cost settlement methodology of the UC ambulance program. Total costless facility costs. The total costless facility cost allocation method can be used if a provider's contracts are mixed, with some being labor-intensive and others having a programmatic or residential building component. This method allocates costs based upon the ratio of each contract's total costs, less that contract's facility or building costs, to the provider's total costs, less facility or building costs for all contracts. When using the total costless facility cost allocation method, the facility costs to be removed from the cost calculation include lease or rental of building, facility and building equipment, insurance for those items, utilities, maintenance, and contract services of those items, mortgage interest, ad valorem taxes, and depreciation for building, facility, building equipment, land, and leasehold improvements. In this example, the direct facility costs for the PHC contract, highlighted in pink, are summed and carried down to the small table in the cell highlighted in blue. In the facility costs row, for each contract, subtract the total facility costs of the contract from the total direct costs of the contract. The total direct costs for the PHC contract is highlighted in green. The total facility cost for the PHC contract is $5,874.40. The total direct cost for the PHC contract is $106,684.84. Subtract the total facility costs of the contract from the total direct costs of the contract, and you will get $100,810.44. This is highlighted in orange. To determine the allocated percentage of a contract, the total costless facility cost for one contract is divided by the total costless facility cost of the entity. To get the allocated shared costs for each business component, multiply each shared cost by the allocated percentage of each business component per expense type. We will now discuss the functional allocation method. With this method, any function benefiting more than one contract must have all costs associated with that shared function properly allocated across all the contracts receiving this benefit. Costs to be allocated using functional allocation method include, but are not limited to, housekeeping, laundry, maintenance, wastewater treatment, plant activities, transportation, departmental equipment, various administrative functions. For a full list of cost types, please refer to the cost report instructions. An example of a functional allocation is allocating based on square footage. This allocation is used when a building is shared and usage is separate and distinct for each contract. The building cost should be identified and then allocated based upon square footage. Expenses that can be allocated based on square footage are rent or depreciation, mortgage interest, utilities, maintenance, property taxes, insurance. Please note, telecommunications, transportation, and departmental equipment cannot be allocated based on square footage. Now we will look at some other cost allocation methods. A time study reports the amount of time related to performing direct medical services, as derived from data obtained from the Random Moment Time Study, RMTS, statewide time study. Random Moment Time Study, RMTS, identifies the reimbursable and non-reimbursable time, which is then used to identify the percent of time providers are participating in Medicaid-administered contractor MAC activities or direct medical services. Medicaid eligibility rate calculates the percentage of individuals in an entity who are Medicaid eligible quarterly. The quarterly MER is calculated by dividing the total number of matches from the Medicaid eligibility file to enrollments in PIMEs, then divide by the total number of enrolled individuals. The next allocation method we will discuss is the unrestricted indirect cost rate, or IDCR, which needs to be requested annually from TEA. IDCR helps a district recover some of its indirect costs by providing a district with an indirect cost rate to recover organization-wide administrative costs to manage federal grants. Allowable administrative costs include accounting, budgeting, purchasing, auditing, and payroll processing. Next, the following other allocation methods are used by the SHARS program. Individualized Education Program, IEP ratio, refers to the percentage of students with IEPs requiring direct medical services with Medicaid, parental consent, and a paid claim. One-way trip. OWT ratio refers to the number of paid one-way trips for students with Medicaid and parental consent over all one-way trips for students with an IEP requiring specialized transportation services. Specially adapted vehicles used to transport students that have a special adaptation as prescribed in a student's IEP. This lesson provides information on the appropriate LTSS allocation methods for reporting shared costs. This table shows a breakdown of appropriate allocation methods based on the makeup of the controlling entity's contracts. The provider can use more than one allocation method per report. This table shows cost allocation methods for reporting shared costs for acute care and hospital programs. This table shows a breakdown of appropriate allocation methods based on the makeup of the controlling entity's contracts. The provider can use more than one allocation method per report. This concludes our lesson for Module 5. Welcome to Module 6 of the Cost Report Foundational Requirements, where we will discuss depreciation. Let's begin our first topic with a definition of depreciation. Depreciation is a systematic process of allocating the cost of a tangible asset over its useful life. Tangible assets are physical items a business owns, such as machinery, equipment, buildings, and vehicles. By using depreciation, providers can accurately reflect the decrease in value of their assets over time. According to 1 Tax Section 355.103(b)(10), depreciation on the cost report must follow the straight-line method to ensure consistent calculations. The depreciation process should begin in the month the asset is placed in service, allowing for accurate allocation of costs over time. As per the guidelines, depreciation should continue until the asset is either fully depreciated or removed from service entirely. It is essential to cease claiming depreciation for any asset in the month it is taken out of service to comply with reporting requirements. Now that we've reviewed the concept of depreciation, let's discuss when we would apply depreciation to the cost report. Depreciable assets will need the following information: asset description, the name, account code, or both. Month and year placed in service. The month and the year that the depreciable asset was first put into service. Month and year of disposal. The month and year that the depreciable asset was removed from service. Year's useful life. Numeric value from the depreciation schedule. Historical costs. The asset's costs as identified on the depreciation schedule. Salvage value. The value of the asset after depreciation has been fully expensed. Prior period accumulated depreciation. The total amount of depreciable expenses to date related to the depreciated asset. It is appropriate to use depreciation when items that cost $5,000 or more and have a useful life exceeding 1 year are typically subject to depreciation, which allows businesses to spread the cost over several years. This accounting method recognizes the gradual decline in value of a long-lasting asset as it is used in operations. Conversely, items that are priced below $5,000 or have a lifespan of 1 year or less are recorded as an immediate expense. The 2023 Estimated Useful Lives of Depreciable Hospital Assets is a valuable reference guide designed to assist healthcare organizations in understanding the lifespan of their financial assets. This guide was developed in partnership with the Healthcare Financial Management Association, HFMA, to ensure accurate and relevant information for the healthcare sector. It provides detailed estimates for a wide range of commonly used depreciable assets. Additional information and resources can be accessed on the American Hospital Association's website. For direct inquiries, individuals can contact AHA Services at 1-800-424-4391 or via mail at 155N. Wacker Drive, Chicago, Illinois, 60606. Next, let's review a few assets that are eligible for depreciation. The cost report indicates that luxury vehicles need to be depreciated when their purchase price exceeds the allowable base value. Each year beginning January 1, 1998, an additional 2.0% is compounded and added to the base value for the calculation of luxury vehicle depreciation. On the cost report, buildings are categorized as depreciated items, reflecting their declining value over time. The minimum useful life for these structures is established at 30 years, ensuring that their depreciation is aligned with realistic expectations. Additionally, depreciation for transportation assets is calculated based on the expected useful life of various vehicle types. It's important to note that specialized equipment added to a vehicle to assist a client should be depreciated separately from the vehicle itself. For instance, wheelchair lifts, which are commonly used, have an estimated useful life of 5 years, requiring appropriate depreciation calculations. For more examples of depreciable items, please review the cost report instructions. The minimum depreciation schedules are outlined in Section 355.103(b)(10) and can be referenced in Appendix D, which lists useful lives for depreciation in the cost report instructions. Next, we will look at the specific asset information needed for detailed level depreciation. Now let's discuss calculating useful lives for assets. Imagine it as the foundation of your asset's value. It's calculated by taking the historical cost and subtracting the salvage value. This figure helps you understand how much value your asset will lose over time, providing a clearer picture of its worth in your financial landscape. This ensures that asset depreciation is managed in accordance with established industry standards, providing clarity and consistency in financial reporting. This concludes our lesson for Module 6. Welcome to Module 7. This lesson provides an overview of vendor hold related to the Provider Finance Department. We will discuss vendor hold placements, provider notifications, and vendor hold releases for applicable cost reporting programs. As outlined in 1 TAC, Section 355-111, a vendor hold involves the temporary suspension of payments to a provider due to administrative contract violations. A significant reason for a vendor hold is the failure to submit an acceptable cost report, which is considered an administrative contract violation. To avoid this violation, cost reports must comply with PFD's guidelines, including adherence to allowable costs and timely submission. Additionally, essential supporting documentation must accompany the cost report to ensure it meets the established criteria. First, vendor holds can be implemented for the non-submittal of cost reports. Participating facilities must ensure that their reports are submitted by the annual due date of April 30th, as failing to do so may result in being placed on vendor hold. Upon request, HHSC may grant an extension to providers who fail to submit a cost report by the due date. The vendor hold will remain in effect until an acceptable cost report is submitted. Each financial examination undergoes a peer review process to confirm that all procedures followed adhere to government financial examination standards and HHSC policies. The examination process is designed to ensure accuracy and reliability in the evaluation of financial and statistical information contained in the cost reports. The reviews specifically examine financial and statistical elements as mandated under TAC Rule 355.105(b)(4) to ensure compliance and accountability. HHSC financial examiners, FEs, are tasked with completing thorough financial examinations to verify that each submitted cost report complies with the Texas Administrative Code, TAC requirements. Failure to adhere to the instructions and rules when completing cost reports is deemed an administrative contract violation by HHSC. If a provider does not meet this compliance requirement, a vendor hold may be enacted to address the violation. Procedural guidelines for addressing administrative contract violations, including avenues for informal reconsideration and appeal, are outlined in Section 355.111 of the title. Additionally, HHSC provides a compliance period for all other types of administrative contract violations to ensure providers have the opportunity to rectify issues. Next, we will discuss how providers are notified of a vendor hold status. HHSC will provide a vendor hold notification to inform the provider of a warning status or vendor hold implementation. A vendor hold warning, issued through the STEPS cost report system, may provide 15 days to give providers adequate time to address any issues. If a cost report is deemed unauditable or unacceptable, the provider notification will include supporting documentation requested and action items needed to remedy the situation. A formal vendor hold letter will be both mailed and emailed to the provider for official documentation following the placement of a vendor hold. Timely communication from HHSC helps to maintain a cooperative relationship between the Commission and service providers. This concludes our lesson on provider notifications. Next, in Module 7.4, we will discuss the vendor hold release process. Finally, let's discuss the process to be released from a vendor hold. HHSC will initiate a request for the vendor hold release once all required reports have been submitted. The Cost Report Review Unit, CRRU, plays a critical role in this process by assessing the submitted documentation for compliance. In cases where an unacceptable report is identified, CRRU will communicate the findings and request additional documentation as necessary. By adhering to these guidelines, HHSC aims to maintain transparency in the reporting process. This concludes the discussion on vendor holds for Module 7.
In Module 8, How to Complete Cost Report Sections 1 through 3, we will provide an overview of the cost report, detailing its components and significance in completing the cost report. Let's begin with an overview of Sections 1 through 3. Section 1 of the cost report aims to verify the combined entity's reporting period and communicate cost report resources available. The primary goal of Section 2 is to collect general information and verify the combined entity's primary entity contact and financial contact. Accurate contact details are vital to ensure the provider receives all relevant correspondence about the cost report review. Errors or outdated information can cause delays and missed communications, disrupting the review process. The purpose of Section 3 is to confirm provider identification and add other business components to the cost report. The primary goal of Section 1 is to verify the combined entity's reporting period and communicate cost report resources available. Section 1 of the cost report is an introduction that provides information on the cost report type, the cost report beginning and ending period, and the due date. The cost report type and the cost report period are pre-populated in this section. It is important to note that the report period is based on the state fiscal year in accordance with TAC 355.105C. The cost reports must be prepared to reflect the activities of the provider while delivering contracted services during the fiscal year specified by the cost report. Each provider is responsible for accurately completing any cost report submitted to HHSC. If there is a discrepancy, the cost report will be rejected as unacceptable and returned for proper completion. This applies to all programs except the Single Source Continuum Contractor (SSCC) program, which has cost reports due quarterly. Section 1 also includes cost report resources available. The cost report instructions will include a thorough description of each section and provide examples accordingly. Section 2 of the cost report aims to gather essential contact information for HHSCPFD, ensuring effective communication with the provider and preparer during the review process. Accurate contact details are vital to ensure the provider receives all relevant correspondence about the cost report review. Errors or outdated information can cause delays and missed communications, disrupting the review process. In this lesson, you will learn the combined entity information that is pre-populated and where HHSC obtains this information. The combined entity information line items include entity name, National Provider Identification, NPI, Employer Identification Number, EIN, and Entity Contact Details, which are pulled from Provider Enrollment and Management System, PEMS, except for 24 RCC and SSCC. The Resource ID and the Site Type line items only apply to 24 RCC and SSCC. This information is pulled from Information Management Protecting Adults and Children in Texas Impact, a DFPS database. The Facility ID identifier only applies to NFs and is pulled from the Texas Unified Licensure Information Portal, TULIP. Financial examiners will ensure that only your expenses associated with the components under the appropriate Medicaid entity information are reported on your cost report. If the information is inaccurate, please submit a support ticket to ensure that all combined entity information is displayed correctly. Let's continue discussing entity information in detail. Section 2 of the cost report outlines the specific requirements for designating a primary contact, financial contact, and cost report preparer, each of whom plays an essential role in the submission process. The primary entity contact, PEC, can assign primary and secondary roles to the financial contact. PEC and primary financial contact, PFC, can assign a preparer. These actions can occur prior to completing the required training. Role assignments are conducted within the dashboard screen prior to accessing the cost report. The information will appear pre-populated in Section 2. This image displays the screen view for Section 2 of the cost report. Providers will receive reminder notifications from STEPS if reports are not submitted by the set deadlines. The primary entity contact and financial contact must log into the system to review all notifications and take necessary actions. Notifications are sent regarding any adjustments made to cost reports after certification, including potential recoupments that may impact financial planning. Also, maintaining accurate contact information is essential for providers to stay informed and effectively manage their reporting responsibilities. PFD may request supplemental information to validate information entered in the cost report. When identifying the entity contact, the primary contact person must be an employee of the controlling entity, such as a parent company or related party management company. This designation must be formally recognized on the entity contact certification to ensure clarity and compliance. The selected contact person should possess the knowledge necessary to address inquiries regarding the contents of the provider's cost report. It is important to note that the information provided will be view-only to maintain data integrity and confidentiality. The entity contact must certify the accuracy of cost reports submitted to HHS PFD. Providers may be liable for civil and criminal penalties if the cost report is not completed according to HHSC requirements or is determined to contain misrepresented or falsified information. Please refer to the Provider Enrollment Management System, PEMS, to update your primary entity contact. Next, we will discuss the assignment of financial contact. A primary contact has the authority to designate a financial contact for the review of the cost report. The financial contact cannot enter data into the system and will be included on all provider communications from STEPS and can file an informal review. However, the financial contact cannot complete the PEC certification. To qualify as a financial contact, the individual must be an employee of the controlling entity, parent company, sole member, governmental body, or related party management company. It is important to note that externally contracted preparers are not permitted to serve as a provider's financial contact. Next, we will discuss the procedure for identifying a cost report preparer. The preparer must be the individual who prepared the cost report or has primary responsibility for preparing the cost report for the provider. According to 1 Tax Section 355.102d, the cost report preparer can either be an employee of the provider or a contracted individual who specializes in cost report preparation. Signing as preparer carries the responsibility for an accurate and complete cost report prepared according to applicable methodology, rules, and instructions. Signing as preparer signifies that the preparer knows the applicable methodology, rules, and instructions, and has either completed the cost report himself or herself according to those rules and instructions, or has adequately supervised and thoroughly instructed his or her employees in properly completing the cost report. The ultimate responsibility for the cost report lies with the person signing as preparer. Outside preparers, however, are prohibited from being designated as either entity or financial contacts in the cost report documentation. Section 3 verifies the provider identification associated with this cost report. HHS CPFD uses this information during the cost report examination process. Financial examiners, FEs, will ensure that only your expenses associated with the component under the appropriate Medicaid contract are reported. Section 3 provides a comprehensive overview of the steps required to verify provider information within the cost report. First, we review the pre-populated identification numbers that apply to all cost reports. Then, we identify the requirements for other business components to ensure all data is correctly captured. The lesson also details how to accurately indicate the reporting period for each contract involved. Let's begin with a review of key terms and definitions for this section of the cost report. In this section of the cost report, understanding the contract types and service types is crucial. The contract type options include DFPS, DSHS, HHSC, State of Texas, federal government, local government, and non-state. The service type options include early childhood intervention, mental and individuals with developmental disabilities, primarily targeted case management, and psychosocial rehab. The service types only apply to MEI cost reports. A business component is defined as a distinct business entity, which may include state contracts, programs, or grants that operate independently from the main contracted provider's agreement. Each component is considered part of a larger system of entities that are connected through shared ownership or control. For example, programs such as Medicare and CACFP may represent different business components under one overarching organization. It is important to note that each separate contract with the state of Texas is typically regarded as its own distinct business component and entity. Understanding the structure of business components is crucial for managing regulatory policies effectively. Providers will be able to allocate shared costs of business components listed only in Section 3. Financial examiners will review the expenses associated with the specific components outlined in the relevant Medicaid contracts to ensure accuracy. Any discrepancies or failures in proper verification may result in the cost reports for the combined entity being deemed unacceptable. In this section of the cost report, you must review all the HHSC and managed care organization information associated with the cost report, including STAR Plus for CPC and DAHS reports. Section 3. Provider identification associated with the cost report will be populated for all reports except the SSCC report. If you notice that not all relevant HHSC provider information is listed, then you must submit a ticket promptly to request an update. Now that we have identified the provider information in this section, we will next discuss reporting other business components. This image displays the screen view for Section 3. In this section, please enter any other contracts, grants, or business relationships with the state of Texas, or any other entity or other funding sources. In the Other Business Components table, users will have the opportunity to select a contract type and service type. Users can enter text for the business component, contract number, and entity name. Entering contract numbers is required for all contract types except the non-state contract type. Contract numbers are required for all entries on the MEI report. The next section describes the process for determining if your contract was active for the entire reporting period. Section 3, Reporting Period section, inquires whether your contract was active for the entire reporting period. You will need to select either yes or no to indicate the status of your contract during this time. If you select yes, the reporting period will be documented as September 1, 2025. Conversely, if you select no, please provide the actual start date in the month, date, year format. Please make certain that this date falls after September 1, 2025 to ensure accurate reporting. This concludes our lesson for Module 8. In Module 9, the focus of the cost report section is to provide an overview of the general information required for submission. Additionally, HHSC incorporates a series of questions that delve into specific aspects, such as wages and compensation structures. The report also inquires into facility and operation costs, along with pertinent questions related to building requirements. Finally, it addresses emergency situations, ensuring that all potential risks and responses are accounted for in the cost assessment. The purpose of this section is to collect vital accounting and program-specific information for accurate cost reporting. It requires identifying the accounting methods, documenting Section 125 details for relevant programs, submitting information regarding TWC reimbursing employers, and verifying units of service delivery for LTSS programs. Ultimately, collecting these details ensures compliance, maintains accurate records, and allocates costs effectively among programs. Section 4 provides a pick list to select the entity type. The entity name, entity classification, and the cost report period are pre-populated fields. This slide provides a preview of Section 4 of the cost report. In this section, users will provide essential details pertinent to the cost report, focusing on the chosen accounting methods. The required information includes whether an accrual method of accounting was used during the reporting period. Users must also provide specific information regarding Section 125. Additionally, TWC reimbursing employer information is necessary for participants in LTSS programs. For more information on these questions listed on the General Information section, please review the cost report instructions. The purpose of the wages and compensation questions is to identify and accurately report any employee-related self-insurance expenses and related party wages or compensation included in the provider's cost report. This ensures compliance with reporting requirements, proper classification of expense types, and transparency in financial relationships affecting cost allocation. Now, let's discuss the wages and compensation questions. In this section, we will review the various employee-related self-insurance expenses that the provider must include in their cost report, applicable to all programs. Please ensure you select all relevant employee-related self-insurance expenses to accurately reflect the financial responsibilities of the provider. For all LTSS programs, providers should also specify any other types of employee-related self-insurance expenses that may be applicable. This slide demonstrates the screen view for Section 4, Wages and Compensation Questions. The purpose of the Facility and Operations questions is to capture and accurately report any asset or operations-related self-insurance expenses and shared facility and operations costs included in the provider's cost report. This information ensures proper cost allocation, compliance with reporting requirements, and transparency in identifying related party management expenses that must be classified as central office costs. The facility and operation cost questions apply to all long-term services and supports LTSS programs. Users must identify and select all applicable asset or operations-related self-insurance expenses to address the cost report question. One key question to address is whether the provider has any asset or operations-related self-insurance expenses to include in the report. Additionally, providers are asked if they have any shared facilities or operational costs that should be included in the report for a comprehensive financial assessment. If the user selects No for shared costs, the section related to shared facilities and operations will be locked to prevent any modifications. Shared costs are expenses that benefit multiple entities and are not solely allocated to one, thus requiring a fair distribution method among the entities involved. To allocate these shared facility and operations costs, please identify the appropriate allocation method, which may include choices based on usage, headcount, or revenue. While most cases typically require only one allocation method, you may choose to use multiple methods if you opt for the square footage or time study approaches for a more detailed allocation. For further guidance, please refer to the Allocation Methodology Guide. This slide demonstrates the screen view for Section 4, Facility and Operation Cost Questions. The building questions determine whether the provider leased any buildings used for program services or central office operations during the cost reporting period. This information is necessary to ensure accurate reporting of facility-related costs and compliance with cost allocation requirements. In this lesson, we will discuss important questions related to the leasing of buildings, where program services are conducted during the cost reporting period. It is important to identify whether the building where the program services were provided was leased during this period, which applies to all programs. Additionally, you will need to determine if the central office building was also leased during the cost reporting period, and this applies to all programs. A preview of the screen for building questions is provided on this slide. Next, let's conclude our discussion by exploring questions related to emergency situations. The purpose of the emergency situation questions is to identify and document extraordinary circumstances, such as natural disasters or public health crises, that resulted in a state or federal emergency declaration during the cost reporting period. This information ensures accurate consideration of any impacts these events may have had on operations and cost reporting. In this section, the emergency situation questions are designed to be applicable across all programs. An essential aspect involves assessing scenarios related to natural disasters, such as hurricanes, which result in state or federal emergency declarations. Another critical area of inquiry addresses public health crises, as highlighted by circumstances such as the COVID-19 pandemic. By integrating these questions, HHSCPFD aims to enhance preparedness and responsiveness to a wide range of emergency situations. This slide demonstrates the screen view for Section 4 Emergency Situation Questions. This concludes our lesson for Module 9. Section 4.1 discusses documenting all land and buildings or improvements located in Texas and owned by the provider's corporation or related business entity. This section will apply to all LTSS reports except CPC, 24 RCC, SSCC, and SSLC. It does not apply to all MEI reports. The purpose of the land and building or improvements is to ensure compliance with the 2026-27 General Appropriations Act, Senate Bill 1, 89th Legislature, Regular Session, 2025, Article 2, Rider 32, by collecting accurate and complete cost report data from providers. Providers must report information on assets located in Texas, including property, buildings, and improvements owned by the provider's corporation or related business entity during the cost reporting period. Supporting documentation must be correct, complete, and submitted timely, as cost reports will be deemed unacceptable if these requirements are not met. In this lesson, we will explore the essential information regarding land and buildings, or any improvements made to these properties. We will also cover the types of asset information that need to be collected for accurate evaluation and analysis. Finally, we discuss the various supporting documentation required to verify the accuracy of the collected information. Let's begin the lesson on Section 4.1 with a discussion of the essential information. As stipulated in Article 2, Rider 32, the Health and Human Services Commission, HHSC, shall collect information from each Medicaid long-term care provider that provides residential or facility-based services for the purpose of submitting a cost report to determine the profits and losses incurred by each provider, including any non-Medicaid revenues and costs. Providers will submit cost reports to HHSC and include information on assets located in Texas, such as property, buildings, or improvements that were owned by the provider's corporation or related business entity during the cost reporting period. Be diligent in gathering and submitting all required documentation along with your cost report to avoid potential delays or rejections from the reviewing authorities. Documentation supporting the reported assets must be accurate and comprehensive to ensure compliance with the requirements. HHSC will return all cost reports as unacceptable and place the provider, along with any associated Medicaid contracts, on a vendor hold for those who fail to complete this section or provide supporting documentation as an administrative contract violation, per TAC Rule 355.111. For Managed Care Organization, MCO contracted providers, HHSC will notify MCOs of the providers who fail to complete this section or provide supporting documentation. MCOs will be responsible for enforcing the vendor hold per TAC Rule 355.101. Vendor holds will be released when providers resubmit an acceptable report with complete information. We have reviewed the information in Section 4.1 of the cost report. Next, we will examine the collected asset information and the documentation needed to validate these transactions. To ensure the accuracy of the cost report, we must carefully review the asset information that has been gathered. Essential documentation includes the fair market value of the assets as they were on January 1st, which serves as a baseline for valuation. More information is available in the cost report instructions. Additionally, we need to verify the purchase or acquisition price along with the date when the assets were obtained. For any assets that have been sold, we must document the sale price. Lastly, it is essential to calculate the net profits or losses related to the sale of these assets to provide a comprehensive financial overview. This slide demonstrates the screen view for Section 4.1 of the DAHS cost report. This concludes our lesson for Module 10.
In Section 5, we will discuss reporting related party transactions and costs. The purpose of this requirement is to ensure full compliance with 1 Tax Section 355.102I6 by mandating disclosure of all related party transactions on the cost report. This includes any costs incurred by the contracted provider, regardless of whether the transactions occur at the central office level or the individual contracted provider level. Complete and accurate reporting promotes transparency, prevents conflicts of interest, and supports proper cost allocation in accordance with state regulations. Disclosure of all related party information on the cost report is mandatory for all costs incurred by the contracted provider, regardless of the level at which related party transactions occur within the organization. HHSC identifies related party information to ensure that related party transactions are allowable. The provider needs to provide adequate documentation upon request to support any costs attributed to related parties. This documentation must clearly identify the total costs incurred by the related person or organization and demonstrate the allocation methods used for both direct and indirect costs. If the contracted provider does not supply sufficient documentation to justify the costs attributed to the related party, those costs will be deemed unallowable according to established guidelines. Section 5 of the cost report collects information about related party information that providers are required to disclose. Providers must indicate whether the related party is a person or an organization. If the related party is an organization, enter the necessary information using the drop-down options for the organization name. If the related party is a person, the provider will enter the related party's information for the line items, first name, last name, and birth date. If the answer is yes to whether the related party is a person, then the provider will also indicate the number of total hours worked and total compensation as currency using whole numbers. Next, the provider must indicate whether the related party is a legal owner of the entity by selecting either yes or no. If the answer is no, then the provider is prompted to answer, what is the related party's relationship to the provider? If the answer is yes, then the provider will be prompted to answer what percentage of legal ownership the related party holds in the entity. This must be represented by a numerical value with 2 decimal places, no zeros, and no negative numbers. Please select yes or no to indicate if any loans or credit lines obtained by the related party are utilized, in full or in part, by this entity. If yes is selected as the answer to the question above, then the provider will be prompted to provide the following information. Related party loan documentation. Please provide documentation for each loan held by the related party that is used by this entity. It is essential to verify that each loan's documentation includes the following details: loan agreement or reference, origination date, principal and outstanding balance, loan term in months, interest rate, and interest amount. Next, the provider will select either yes or no to indicate if there is any equipment obtained by the related party that is used, in whole or in part, by this entity. If yes is selected as the answer, then the provider must report any, quote, related party non-depreciable equipment and supplies documentation. Please provide documentation for each piece of equipment held by the related party that is used by the entity. For each piece of equipment, ensure your documentation includes the actual cost to the related party. Finally, the provider will select either yes or no to indicate whether any contracted services are provided to this entity by the related party. If yes is selected as the answer, then the provider must report any, quote, related party contracted services documentation. Please provide documentation for all contracted services provided by the related party to the entity. For each service, ensure your documentation includes the actual cost to the related party. This slide demonstrates the screen view for Section 5 of the cost report. The provider needs to provide adequate documentation upon request to support any costs attributed to related parties. This documentation must clearly identify the total costs incurred by the related person or organization and demonstrate the allocation methods used for both direct and indirect costs. It is essential to note that if a contracted provider fails to provide adequate documentation to substantiate the cost to the related person or organization, the reported cost is deemed unallowable. For further guidelines regarding adequate documentation, refer to Section 355.105(b)(2) of this title relating to general reporting and documentation requirements, methods, and procedures. This concludes our lesson for Module 11. In Sections 6 and 6.1, we will discuss how to report paid units of service, days of services, placement days, and revenue information. Section 6 involves the collection of service and revenue data, which HHS-CPFD uses to verify the contracted provider's revenue to calculate a per-unit cost for rate setting and for Rider 23 and annual patient expense ratio compliance. Providers must review pre-populated paid service utilization according to the billing increment established by HHS-CPFD. The service utilization and revenue values are editable fields. If the provider adjusts values on the revenue screen, a revenue and paid units adjustments document must be uploaded. Please refer to the cost report instructions for an example of the supporting documentation. You may obtain a record of the fee-for-service, FFS, paid claims from the Texas Medicaid and Healthcare Partnership, TMHP. The TMHP claims report is an example and is not exhaustive of all options available to providers. For the purpose of the training, when we refer to a unit of service, we are referring to placement days, units of service, or resident days. For more information about your program, please refer to the cost report instructions. For every unit, there must be associated costs reported on the cost report, and fields will include private pay and non-Medicaid units. The final reconciliation will occur during the desk review. Let's delve into the details of paid units of service and revenue. Units of service and revenue information are collected for the following programs: Day Activity Health Services, DAHS, Deaf-Blind with Multiple Disabilities, DBMD, Home and Community-Based Services, HCS, STAR, ++ HCBS, and non-HCBS. Community Living Assistance and Support Services, Case Management Agency, Class CMA, Community Living Assistance and Support Services, Direct Service Agency, Class DSA, Assisted Living AL, Primary Home Care, PHC, Community Attendant Services, CAS, Family Care, FC, Home and Community-Based Services, HCS, Texas Home Living, TXHML, and Intermediate Care Facilities for Individuals with an Intellectual Disability or Related Conditions, ICF, IID. Providers must review the pre-populated attendant and non-attendant staff Medicaid units of service by program and service type. Providers must enter the private pay units of service and related private pay revenue by program and service type. For non-reimbursed, report any units where an individual received services, but no payer source reimbursed the unit. Thus, there is no associated revenue at the time of service. The data should be reported based on the date of service provision, and not by the date revenues were received. In other words, data should be reported on an accrual basis. The examples listed on this slide do not include all services and programs that will be reported on the cost report in Section 6. This image displays the screen view for Section 6 of the CPC cost report. For ICF/IID and HCS/TXHML, enter the Medicaid days of service by L, O, N, the non-Medicaid units of service, and related non-Medicaid revenues. HCS also includes reporting units of service, not by LON. In Section 6 of the ICF/IID cost report, you will enter the service by LON for your small, medium, or large facilities. Fields in this section will be pre-populated and require verification by the provider. Now, we will discuss the days of service and revenue information collected in Section 6. Days of service and revenue information are pre-populated for nursing facilities, state-supported living centers, and assisted living. Section 6 of the NF Cost Report will collect RUG 3 paid days, PDPM Lieutenant Colonel paid days, non-Medicaid days, and revenue for each of these categories. For SSLC cost reports, the days of service and revenue information will include SSLC and bond homes days of service, SSLC revenue, SSLC comprehensive medical revenue, and bond homes revenue. Assisted living AL information will include RC apartment paid days and non-apartment paid days. This image displays the screen view for Section 6 of the SSLC cost report. Services that are referred for a single source continuum contractor, SSCC, or a 24-hour residential childcare, 24 RCC client for 1 day of admittance in a residential care facility or foster home placement. A placement day is also known as a day of service or resident day and is the unit of service for a residential program. The day the client is admitted is counted as a day of service. The day the client is discharged is not counted as a day of service. Let's delve into the details of placement days and revenue for 24-hour residential childcare. This information will be pre-populated for FFS and S+P and DFPS referrals. SSCC referrals will not be pre-populated on the 24 RCC cost report. A bed hold is when the state pays the provider to hold an empty bed in case they need to fill it with an emergency placement. Report total bed hold days and revenue regardless of whether beds were occupied. Refer to the instructions for more details. This image displays the screen view for Section 6 of the SSCC cost report. Report the total number of placement days by referral source and type. Report placement days as not by LON when the referring agency does not use DFPS placement levels or defines them differently. LON, level of need, is used when DFPS does not have a specific LON, for example, basic, moderate, specialized, intense, and intense plus assigned. Add any additional sources of revenue not yet reported. Revenues reported under unrestricted gifts, grants, and income from endowments from private sources should include any revenue used to pay for expenses reported from private sources not previously listed. Please refer to Tax Section 355.103(b)(18) for information on the type of revenue that must be offset. Revenues reported under federal, state, and local government sources should include any revenue used to pay for expenses from public or government sources not previously listed. Unrestricted or restricted grants, gifts, and income from privately sourced endowments used to purchase allowable program items should not be offset before reporting. Use the trail balance or work papers to offset this revenue. The provider must maintain documentation for the offset as specified in Section 355.105 BXVII. Please refer to the cost report instructions for additional information. Private pay includes units of service delivered by the entity and paid by a non-Medicaid payer source listed within Section 3 Other Business Components of this report. Any units of service provided that are not reimbursed by any payer source should be categorized as non-reimbursed. Lastly, we will discuss foster family disbursements. This section only applies to 24 RCC reports. Report the total number of foster family pass-through dollars paid to foster families, broken down by referral type and LON. Referral types include DFPS, SSCC, and non-DFPS referred children. This image displays the screen view for Section 6.1 of the 24 RCC Cost Report. This concludes our lesson for Module 12.
In Module 13, How to Complete Cost Report Section 7, we will discuss the necessary information required for recording the contracted provider's wages and compensation, along with depreciation. Let's begin the lesson by identifying the purpose of Section 7. Section 7 of the Cost Report is designed to gather comprehensive information on wages, compensation, and benefits for the contracted provider's staff. Examples of staff types included in this section are attendance, non-attendant staff, administration staff, and central office staff. However, this is not an exhaustive list. Additional categories, such as direct care and non-direct care staff, may also be relevant for reporting purposes. The Health and Human Services Commission, HHSC, utilizes this information to evaluate the overall expenses associated with the contracted provider's employees and staff. In turn, staff expenses play a crucial role in the report reconciliation process, enabling the assessment and verification of compliance with spending regulations. Now that we've explained the purpose next, we will review what information is collected in this section. For each staff type identified, for which costs are incurred, report the following. The data collected on staff costs in this section includes the total staff hours worked as well as the total staff wages. It is equally important to document the total contracted hours, reflecting the hours worked by contracted staff. The total contracted payment should also be recorded to provide a complete picture of expenses related to contracted staff. Note that all related party and non-related party costs must be entered separately to maintain clarity in financial reporting. This image displays the screen view for Section 7, Wages and Compensation of the CPC Cost Report. The operational staff information is relevant to the 24 RCC, SSCC, and SSLC programs, ensuring that these centers are adequately supported by trained personnel. Information regarding attendant and non-attendant staff is applicable to ICF, DAHS, CPC, and AL. HCS and TXHML programs specifically focus on the roles of attendant staff and host home companion care contractors. Administrative staff play a crucial role as their information applies universally across all LTSS programs, supporting operational consistency. By clearly defining the roles and responsibilities of each staff category, providers must ensure that all costs related to staff are reported with accuracy, encompassing all aspects of employee benefits and compensation. This reporting should include expenses such as employee benefits and insurance, as well as FICA and Medicare payroll taxes. Additionally, providers are required to account for state and federal unemployment taxes, as well as workers' compensation premiums and paid claims. It is also essential to include costs associated with third-party contracted services in the reporting process. This slide demonstrates the screen view for Section 7, Wages and Compensation of the CPC Cost Report. For the attendant staff, HHSC is requesting that wages be split between regular wages, overtime wages, and non-hourly compensation. All compensation should be subject to payroll taxes. For more information about the program to which this applies, please refer to the program-specific instructions. This concludes our lesson for Module 13.
Module 14, How to Complete Cost Report Sections 8 and 8.1, discusses how to report depreciation expenses. The purpose of this section is to collect expense information that was directly or indirectly incurred in the provision of contracted services. To begin this lesson, it's important to understand that depreciation refers to the systematic process of allocating the cost of a tangible asset over its useful life. Depreciation expense reflects the decrease in value of an asset as it is utilized over time, serving as a key element in determining the true cost of service delivery. It serves not only to illustrate the ongoing decline in worth, but also as a method for recouping the initial cost of the asset across its operational lifetime. Additionally, supporting depreciation documentation must be included for each individual capital asset to ensure transparency and accuracy in reporting. In Section 8 of the cost report, providers are required to report specific information related to depreciation expense, allocation methodology, and provide supporting documentation for each capital asset. For further guidance on reporting requirements, please refer to Title I, Tax Section 355.103b10, which outlines the specifics of depreciation in financial documentation. In this section, providers will determine their preferred method for reporting depreciable assets, choosing between summary level and line level options. The difference between aggregate depreciation and line level depreciation lies in how assets are grouped and tracked for accounting and reporting purposes. Choosing the line level option allows you to report each asset separately, with the STEP system automatically calculating the depreciation expense for each based on the provided details. It is important to note that regardless of the chosen reporting method, straight-line depreciation must be consistently applied to all assets. If you select the summary level, you will need to report the assets in aggregate while also providing documentation that lists each individual asset included in that summary. It is important to note that regardless of the chosen reporting method, straight-line or aggregate depreciation must be consistently applied to all assets. This slide demonstrates the screen view with a line-level depreciation in Section 8 of the 24 RCC cost report. The STEP system efficiently calculates the depreciation expense for each asset by utilizing the straight-line method, based on the relevant depreciation data provided. Essential information gathered during the calculation process includes whether the asset is shared or not, as well as whether it pertains to a related party or an unrelated party. The system also captures detailed asset types and descriptions to ensure clarity in the classification of each asset. Additionally, the years of useful life and historical costs are integral data points that influence depreciation calculations. It is important to note that while this list highlights key information, it is not exhaustive of all data collected for effective depreciation assessment. In our next discussion on allocation percentage, it is essential to establish guidelines based on asset sharing. When an asset is shared among multiple stakeholders, the total percentage allocated to that asset cannot exceed 100%, ensuring an equitable distribution. Conversely, if an asset is owned solely by an individual, the allocated percentage should automatically default to 100% to reflect complete ownership. To maintain clarity in our allocation system, we will implement a feature that hides the percentage field entirely when an asset is non-shared. Section 8 mandates that providers select an allocation method from various drop-down options in their reports. The available methods include units of service, square footage, salaries, labor costs, cost to cost, total cost less facility costs, and time study. It is essential for providers to accurately identify which allocation method was used. Ensuring the correct selection of an allocation method is crucial for compliance with HHSC regulations. For more comprehensive guidance on HHSC-approved allocation methods, providers should consult Module 5, Allocation Methods, Cost Report Foundational Requirements. Allocating expenses across various categories is essential for ensuring proper financial management within an organization. Fixed capital assets represent the long-term investments made by an organization, such as buildings and equipment. The administration category typically includes costs related to management and support functions that facilitate organizational operations, such as salaries for administrative staff and office supplies. Direct care non-labor costs refer to the expenditures related to patient care that do not include salaries, such as medical supplies, equipment repairs, and facility maintenance. Allocating expenses across various categories is essential for effective financial management, as it allows providers to track and analyze costs associated with different asset types. Key asset categories for expense allocation include buildings and improvements, building fixed equipment, leasehold improvements, and land improvements, which contribute to enhancing property value and utility and are critical for maintaining operational efficiency. Other expense categories, such as amortization and rent/lease costs for both buildings and equipment, play a vital role in understanding cash flow and long-term commitments. Finally, expenses related to specialized equipment such as kitchen and laundry equipment, medical and therapy equipment, and transportation equipment should also be meticulously allocated. In this section, it is crucial to submit comprehensive supporting documentation for all items eligible for depreciation. The documentation must clearly delineate how costs are allocated across various business components and line items. Additionally, it is crucial to clearly specify the allocation between direct and indirect costs to ensure accurate expense classification. In cases where costs are shared among different components, it is essential to provide detailed evidence to support the allocated percentage of these shared costs. Furthermore, providers must include any relevant documentation pertaining to a related party lease agreement to substantiate the depreciation claims. Here is a valuable resource for understanding the estimated useful lives of various hospital assets. For a detailed overview of the assets list along with their corresponding years of useful life, please refer to the 2023 Estimated Useful Lives of Depreciable Hospital Assets. This reference guide is specifically designed to help healthcare organizations assess the lifespan of their financial assets. For more information, you can visit the American Hospital Association's website to access this essential guide. This concludes our lesson on Module 14, How to Complete the Cost Report, Section 8. This section is for reporting depreciation at an aggregate level. Aggregate depreciation refers to the total amount of depreciation recorded for an asset or a group of assets over time. To report depreciation at a line item level, please return to Section 4, General Information, and select line level for the question, How would you like to report your depreciable assets? This section does not apply to 24 RCC, SSCC, or UC ambulance reports. This slide demonstrates the screen view with an aggregate level depreciation in Section 8.1 of the DAHS cost report. This concludes our lesson for Module 14. In Module 15, How to Complete Cost Report, Sections 9, 10, and 11, we will discuss reporting the shared and direct facility, operations, and administration costs. Shared costs, such as administrative overhead, facility maintenance, or staff salaries that support multiple programs, must be clearly reported to ensure transparency in how public funds are used. This helps providers understand how resources are allocated across services. LTSS programs often involve multiple services, for example, home care, nursing facilities, case management. Shared costs need to be properly allocated to each service to reflect the true cost of delivering care. Accurate shared cost reporting is essential for setting reimbursement rates. If shared costs are underreported, providers may be underpaid. If overreported, it could lead to overpayments. This lesson provides a comprehensive overview of the shared facility, administration, and operations costs, and explains how to add the costs to the report. Section 9 includes detailed line items categorized by cost category and cost type. You will need to indicate whether any of these costs were incurred by a related party and enter the dollar amount of the cost. To add shared facility, administration, and operations costs, select a cost category using the drop-down menu. Cost categories are dependent on the program type of the cost report. Available cost categories may include administration, dietary, direct care non-labor, fixed capital assets, non-therapy ancillary, operations. Direct care non-labor only applies to 24 RCC and SSCC. Non-therapy ancillary only applies to NF. Dietary and direct care non-labor costs cannot be shared. Please refer to the program-specific instructions for more information on cost categories. Next, select a cost type using the drop-down menu. Available cost types are based on the cost category that was selected. Cost types listed as Other will require a summary description of expenses included in the category. Supporting documentation is required for every expense within this category. Please refer to the program-specific instructions for more information on cost types. Now we will review some examples of cost categories and the associated cost type. Facility or fixed capital asset is a cost category. Examples of cost types in fixed capital asset include rent, lease, building and building equipment, rent, lease, departmental equipment, other building equipment, contracted services and maintenance, and repairs interest, mortgage loans. The next cost category you will learn about is administration. Examples of cost types in administration include staff training/seminars, licenses and permits, administrative supplies, advertising, consultants, taxes, utilities, and telecommunications. The final cost category we will review is operations. Examples of cost types in operations include contracted services, operations supplies, therapy supplies, comprehensive medical, activity expenses, housekeeping, and non-durable equipment and supplies. Next, we will discuss the supporting documentation required for this section. After selecting the cost type, the user will need to indicate whether the cost was incurred by a related party by selecting yes or no. If the user selects yes, select the applicable related party using the drop-down menu. The available related party is pre-populated based on the related party information entered into Section 5. For the next line item, total cost, enter the dollar amount of the cost. A business component is defined as a distinct business entity, which may include state contracts, programs, or grants that operate independently from the main contracted provider's agreement. Each component is considered part of a larger system of entities that are connected through shared ownership or control. For example, programs such as Medicare and CACFP may represent different business components under one overarching organization. It is important to note that each separate contract with the state of Texas is typically regarded as its own distinct business component and entity. Understanding the structure of business components is crucial for managing regulatory policies effectively. When allocating shared costs, the user must select the business components for which the costs were distributed. A drop-down menu will appear, which includes all business components for the provider entity. Enter the percentage of shared allocation, which should be formatted as a non-negative number expressed to 2 decimal places. The allocated cost for each business component will be automatically calculated by multiplying the percentage allocation by the total cost. This slide displays the screen view for Section 9 of the cost report. This concludes the Section 9 lesson on shared facility, administration, and operations costs. Next, Section 10 provides an overview of how to complete the land and building or improvement screen of the cost report and steps. Accurate reporting of direct costs, such as facility expenses, administrative operations, and program-specific services, is essential for maintaining transparency and accountability in LTSS programs. It ensures compliance with funding regulations, supports fair and equitable reimbursement, and provides a reliable foundation for budgeting and resource planning. By clearly documenting these costs, we help safeguard program integrity and ensure that resources are used efficiently to support the individuals we serve. Section 10 is also designed to collect the total costs associated with facilities, administration, and operations, excluding indirect costs shared among multiple entities. The information collected here is the same as in Section 9, but with consideration for the provider's direct costs instead of shared costs. This section contains collapsible tables for each applicable cost category. The rows for each cost category table contain all applicable cost types. The columns of the tables contain all applicable cost areas, separated by related party and non-related party. For each applicable cost type, the user will enter the total dollar amount. Please refer to the program-specific instructions for more information on cost categories, types, and areas. The next slides provide examples of the types of supporting documentation that may be required for this section. To ensure compliance with reporting requirements, any costs submitted under specific categories must be accompanied by a general ledger. Module 17 provides additional information on required documentation upload. This general ledger must be uploaded in either Excel or CSV format through the document upload screen provided. The categories for which a detailed general ledger is required include administrative supplies, advertising, and various professional fees, such as contracted administrative services and consulting. Additionally, costs related to mortgage loan interest, rent or lease for buildings and equipment, and staff training seminars also necessitate the submission of a detailed general ledger. For more guidance, refer to the cost report instructions, where you can find a detailed list of cost categories and examples of sufficient general ledger documents. For nursing facilities only, if you enter costs in any of the specified categories, you must upload the Schedule G documentation during the document upload process. Schedule G documentation can include a range of items, such as ancillary supplies and services, and contract and off-site therapy expenses. Additionally, costs related to DME purchase, rental and lease, as well as drugs and pharmaceuticals, must also be documented with Schedule G materials. Off-site therapy expenses, oxygen, and therapy supplies are other categories that require corresponding Schedule G documentation for verification. For further clarity and detailed examples of the necessary Schedule G documentation, please consult the cost report instructions provided. This slide displays the screen view for Section 10 of the cost report. This concludes our review of Section 10 on direct facility, administration, and operations costs. Section 11 provides a summary view of the total shared and direct facility, administration, and operations costs entered in Sections 9 and 10. These figures should be checked against the provider's work papers to ensure that all applicable costs have been entered. To adjust costs, return to Sections 9 or 10 to make the needed changes. This slide displays the screen view for Section 11 of the cost report. This concludes our lesson for Module 15, How to Complete Sections 9, 10, and 11 for shared and direct facility, operations, and administration costs on the cost report.
Module 16 will discuss how to complete Section 12 of the cost report, which addresses unallowable costs. The purpose of this section is to gather data on unallowable costs that have been incurred. Reporting unallowable costs ensures compliance with federal and state regulations, prevents misuse of public funds, supports audit readiness, and maintains the integrity and accuracy of financial reporting. These figures are self-reported and will not undergo an audit process. They are provided for informational purposes only. It is important to note that the gathered information will not influence the rate determination process in any way. By collecting this data, we aim to gain a better understanding of the nature of unallowable costs and their potential implications for future reporting. Now that we have a better understanding of allowable costs, let's discuss the specific types of costs that cannot be included in the final cost report. According to 1 Tax Section 355.102G, unallowable costs are explicitly defined as expenses that do not meet the criteria of being reasonable or necessary. These unallowable costs cannot be included in cost reports submitted by providers. Providers may incur such expenses in the course of their operations, but they are not eligible for reimbursement. Providers must differentiate between allowable and unallowable costs to ensure compliance with state regulations. Ultimately, unallowable costs cannot factor into the Health and Human Services Commission's HHSC rate determination process. Coming up, we will review examples of unallowable costs. Unallowable cost types encompass various expenses that cannot be funded. Expenses for both attendant and non-attendant staff, as well as administrative and operations personnel expenses, may fall under the category of unallowable costs and should not be included in funding requests. Additionally, facility, operations, and administrative expenses may be deemed ineligible for reimbursement and cannot be included in the allowable budget. It is essential to remember that all currency amounts should be reported in whole numbers without any negative values or zeros. For more information on unallowable costs, please review the instructions in Module 3. This slide displays the screen view for Section 12 of the Cost Report. This concludes our lesson on Module 16, Unallowable Costs.
Module 17 provides details on how to complete the cost report for Sections 13 and 14. In this lesson, we will review Section 13, Documentation Upload. The purpose of the Documentation Upload section is to collect the required support documentation to verify the information entered on the report. HHSC-PFD uses support documentation during the financial examination and report reconciliation processes. Next, we will review some general information. Providers may be obligated to submit support documentation such as trial balances and allocation summaries to validate the information presented in the report. Providers may be required to submit reports to local or federal jurisdictions. It is important to note that these reports should not be submitted on the cost report unless specifically requested by HHSC. Supporting financial documentation should preferably be system-generated and include the following information in a spreadsheet format: provider name accounting basis report, date range detail account descriptions, vendor names amounts. Items like organizational charts and agreements can be uploaded in a portable document format. Now we will discuss approved formats for support documentation. The following file types are acceptable for upload: portable document format, PDF, document, doc, Microsoft Word Open, XML document, DOCX, portable network graphics, PNG, joint photographic experts group, JPEG and JPG, Microsoft Excel spreadsheet file, XLS, Excel Open XML spreadsheet, XLSX, Microsoft PowerPoint, PPT, PowerPoint Open XML presentation, PPTX. Unless otherwise specified, system-generated files in Excel or spreadsheet format are preferred. The maximum file size allowed is 20 megabytes per file. Now you will learn about what support documentation is required in Section 13. Required documents are based on the information entered into the report. The State of Texas Electronic Provider System, STEPS, will prompt the user to submit any required documents. The report will not be certifiable until all required supporting documents have been uploaded. Users who can upload support documentation include Primary Entity Contact, PECT, Financial Contact, FC Preparer. There are 3 support documentation categories. The first is Land and Buildings in Texas documentation. Please upload documentation for each land and building or improvements located in Texas and owned by the Providers Corporation or related business entity. Please refer to the cost report instructions for more details. This requirement does not apply to SSLC, 24 RCC, or SSCC reports. The next category is General Information Uploads. Types of support documentation that may be required include Reconciliation Work Papers, TWC Reimbursing Employer Documentation, TDPS Self-Insurance Shared Facility and Operations Costs, Allocation Methodology Program Services, Building Lease, HHSC, Schedule D for Program Services, Building Appraisal Form. For examples on the required support documentation, please refer to the cost report instructions for more details. In the Revenue Uploads category, upload the revenue adjustment documentation for all pre-populated units and days along with revenue values that were adjusted by the user in the revenue section. This requirement does not apply to SSLC reports. We will now discuss the expense uploads category. Depending on which cost type values have been entered for, a general ledger or Schedule G document must be uploaded. The general ledger must include detailed documentation of any shared or direct costs. The Schedule G must include detailed documentation of any shared ancillary costs, and only applies to nursing facilities. For examples on the required support documentation and applicable cost types, please refer to the cost report instructions for more details. This slide shows the screen view for Section 13 of the cost report. We will now discuss the report summary in Section 14. Section 14, Report Summary, shows the total reported revenues and total reported expenses entered into steps. It assists the user in reconciling the data entered in the report against the provider's support documentation. Prior to certifying the cost report, the information provided in the report summary is used for verification purposes. Lastly, we will review what information is provided in the report summary section. The cost report data summarized in this section include the following: total revenue reported in Section 6, separated by the revenue type. Total wages and compensation expenses reported in Section 7 for each staff type. Total direct and shared facility, administrative and operations expenses in Section 11 for each cost category. This slide shows the screen view for Section 14 of the 24 RCC cost report. This concludes our lesson for Module 17, Documentation Upload and Report Summary.
In Module 18, we will review how to complete Sections 15 and 16 of the cost report, focusing on the process for report submission and certification. The purpose of the preparer certification is to affirm that the information provided in this report, including aggregate depreciation figures, has been compiled accurately and in accordance with applicable accounting standards and organizational policies. By certifying, the preparer confirms that all calculations, classifications, and disclosures reflect a true and fair view of the asset values and depreciation over the reporting period. This certification serves as a formal acknowledgement of the preparer's responsibility in ensuring the reliability of the data presented, which is critical for informed decision-making and regulatory compliance. Tax Section 355.105, B42, specifies that certifications must include a digital signature. An electronic signature by the preparer and provider is required to complete certification of the cost report. The provider acknowledges that this form of electronic signature is as valid as, and has the equivalent legal force and effect as, a manual or handwritten signature on the document. The preparer and provider agree and understand that by typing their name digitally for this certification, they are providing an electronic signature. Let's begin this lesson with a detailed discussion of the preparer certification methodology required for submitting cost reports. The preparers identified in Section 2 of the cost report must sign the preparer certificate to validate their involvement and attest to its accuracy. The individual signing as preparer must either be the one who prepared the report or hold primary responsibility for its completion on behalf of the providers. The individual signing as preparer must either be the one who prepared the report or hold primary responsibility for its completion on behalf of the providers. Additionally, preparers must certify that they have completed the necessary cost report training and have diligently reviewed all information notifications and cost report instructions, as outlined in Section 15. It is important to note that the information will be pre-populated using the details entered to identify the entity contacts as specified in steps. Section 15 allows preparers to certify the accuracy of cost reports submitted to PFD. Providers may be liable for civil and/or criminal penalties if the report is not completed according to HHSC requirements or is determined to contain misrepresented or falsified information. We use this information to make sure that the provider and preparer have verified the report as per Tax Section 355.105(3). This slide shows the screen view for Section 15 of the cost report. This slide displays the screen view for the digital signatures section of the preparer certification in the cost report. The provider certification form must be completed and signed by a legally responsible individual, such as an owner, partner, corporate officer, or government official, ensuring accountability for the provider's conduct. The primary entity contact can conduct this action only after completing the required training. The provider will be required to review each section of the cost report to navigate to the provider certification form. The signature of the responsible party is completed by entering your electronic signature. Once your submitted information is verified, the report will be logged, and any requests for omissions or document uploads must be submitted through STEPS as a support ticket. Let's take a moment to discuss the digital signature in more detail. This slide features the screen view for a successful submission of the cost report. This concludes our lesson for Module 18. In Module 19, we will provide a complete overview of the financial examination process. The purpose of the financial examination of cost reports is to ensure the integrity, accuracy, and compliance of reported expenditures with applicable state regulations. This process supports fiscal accountability by verifying that costs are allowable, properly allocated, and transparently documented. It enables informed budgeting and financial planning, facilitates equitable rate setting, and reimbursement. Additionally, the examination contributes to program evaluation by providing reliable data for assessing the cost-effectiveness and operational efficiency of the program. The Health and Human Services Commission, HHSC, Provider Finance Department, PFD, conducts thorough financial examinations of certified reports to maintain compliance with Tax Section 355.106. These examinations ensure that the financial and statistical information included in cost reports adheres to all relevant rules and instructions. During this process, HHSC may reach out to the designated entity contact, financial contact, and cost report preparer for further clarification. Such communication is essential for verifying the accuracy and integrity of the reported data. Providers must comply with requests from the Health and Human Services Commission (PFD) by furnishing any reasonable documentation within 10 working days, or an alternative timeframe specified by HHSC PFD as outlined in Tax Section 355.105. During the financial examination process, adjustments may be made to either eliminate unallowable costs or to acknowledge unreported or understated allowable costs based on supporting documentation. The determination of these adjustments heavily relies on the supporting documentation provided by the provider or any further clarification sought from them. This requirement ensures that the provider finance department can effectively conduct financial examinations and verify compliance with established regulations. Reports may be classified as unacceptable or unauditable in accordance with Tax Section 355.105, triggering a formal notification to providers. An unacceptable report is characterized by incomplete cost reports that do not adhere to procedural instructions and rules, constituting an administrative contract violation. Conversely, an unauditable report contains all required documentation, but is unable to pass the audit due to discrepancies identified during the review process. Upon such a determination, providers are given 15 calendar days to remedy any deficiencies and resubmit the corrected report for certification. If a provider fails to submit an acceptable corrected report by the designated deadline, it may result in a contract violation and could lead to a recommendation for a vendor hold. This concludes our lesson for Module 19. In Module 20, How to Complete Cost Report Sections 17 and 18, we will cover the summary of adjustments and informal review process. The purpose of this section is for the designated provider, referred to as the entity or financial contact in STEPS, to examine the adjustments made during the financial examination by HHS CPFD. Providers are allotted a 30-day period to carefully review these adjustments to ensure accuracy and completeness. This review period serves as an important opportunity for providers to consider the implications of the adjustments made. During this time, providers can choose to either request an informal review to discuss their concerns or to accept the adjustments proposed by the financial examination. Once the adjustment summary is ready for the provider to review, HHS-CPFD notifies both the entity and financial contacts through the STEP system. The provider has 30 days to review the adjustments. The provider may accept the proposed adjustments or disagree and request an informal review. If no action is taken by the provider, this results in the automatic acceptance of any proposed changes by HHS CPFD. It is important to note that per TAC Rule Section 355.107a, the email serves as the official notification from HHSC regarding any adjustments to the report, including a summary of potential recoupments, if applicable. The adjustment report shows changes to original values, adjusted amount, and the reason for the adjustment. Remember, the provider has 30 days to review the adjustments. If not, you will agree by default. If the adjustments raise any concerns, PFD recommends that the provider submit an informal review within the 30-day review period to help clarify or remedy any issues with the financial examiner. It should be noted that Rider 23 and NF patient care expense ratio determinations will be on the adjustment report. Section 17 allows the provider to either agree or disagree with the adjustment report. Only individuals legally responsible for the contracted provider, such as a sole proprietor or corporate officer, can complete this section and must be designated in STEPS as entity contact or financial contact. Preparer contacts cannot complete Section 17 unless also listed in one of these roles. Failing to select agree or disagree within 30 days will default to agreed. If a provider chooses to disagree, they must request an informal review as outlined in TAC Section 355.110. Clear instructions for this process will follow the disagree selection. Late requests will not be accepted, and missing the deadline also restricts the provider from requesting an administrative hearing on exclusions or adjustments. Providers should review the recoupment summary information if they participated in rate enhancement. Selecting agree finalizes the report. If applicable, providers facing a recoupment amount of $25,000 or higher have the option to select I agree and request a payment plan in Section 17. Please note that payment plans are not guaranteed and are only applicable to active contracts. If a contract terminates before the recoupment process is completed, any approved payment plan will no longer be valid. Providers with a recoupment of over $25,000 for a 12-month period can request to make payments in 3 equal monthly installments. In cases where the recoupment exceeds $75,000 within the same 12-month time frame, providers may request to have the amount collected in 6 equal monthly payments. To initiate a payment plan request, you will need to submit a request letter. The request letter must be printed on the official letterhead of the contracted provider to ensure authenticity and proper identification. It is essential to clearly specify the payment plan type and duration, if applicable, to facilitate a transparent agreement. The letter must be signed by an authorized individual who is legally responsible for the actions of the contracted provider, which can include positions such as sole proprietor, partner, governmental official, or corporate officer. The payment plan request must be uploaded in this section, which will finalize your report and formally request a payment plan for the recoupment. The request letter for payment plans must be printed on the contracted provider's letterhead, signed by an individual legally responsible for the conduct of the contracted provider, and must be scanned to the Provider Finance Department if emailing. Send written requests to Texas Health and Human Services Commission Provider Finance Department, MCH 400, P.O. Box 1490030, Austin, Texas 787149030. Now that we have completed the process for a payment plan request, let's move on to discussing how to request an informal review. Providers will gain access to this section after PFD has notified them that their adjustments are ready for review. It is imperative that providers use this as an opportunity to review any adjustments made and agree or disagree within the 30-day period provided. If the provider disagrees with the adjustments made during the desk review, they may proceed with the informal review request. If no action is taken, the adjustment report will be agreed to by default after the review period. In this step, users can examine the recoupment summary and track the status of the informal review once notifications have been issued to the provider. To view the revised provider adjustment report, please log in to your report and steps, keeping in mind that only those designated as the primary entity contact or financial contact will have access at this stage. The revised adjustment report details each line item adjusted, showing the initially reported amount, the new adjusted amount, and any relevant application information. If a provider disagrees with the outcome of an informal review, they have the right to file for an administrative hearing or formal appeal within 15 days. This formal appeal process is separate from the STEP system and requires adherence to specific guidelines. If you disagree with the adjustment notification, you have the option to file for an informal review in Section 17 with a 30-day window to submit your request. To initiate the informal review, you will need to upload the necessary documents and steps, including a concise statement that outlines the specific actions or determinations you are disputing. Additionally, a 15-day provider disagreement extension is available upon request within the 30-day review period. Any supporting documentation must clearly relate to the dispute and should include system-generated expense information presented in a spreadsheet format. If disputing an adjustment, clearly indicate which adjustment is in question and provide the corrected value along with supporting documentation to substantiate your claims. It is important to note that the interested party must provide all relevant information when requesting an informal review. Requests that do not meet the requirements will not be accepted. The request must include all necessary elements as defined in TAC Section 355.110, C1, a concise statement of the specific actions or determinations it disputes, recommended resolution, and any supporting documentation the interested party deems relevant to the dispute. Signed by a legally authorized individual, the informal review request must be submitted prior to the due date. It is the responsibility of the interested party to render all pertinent information at the time of its request for an informal review. A request for an informal review that does not meet the requirements outlined above will not be accepted. The request must be signed by the individual legally responsible or their legal representative. The following Texas administrative codes provide additional information to support the informal review process. A provider may dispute an action or determination under the following rules. Section 355.102, General Principles of Allowable and Unallowable Costs. Section 355.103, Specifications for Allowable and Unallowable Costs. Section 355.104, Revenues. Section 355.105, General Reporting and Documentation Requirements, Methods and Procedures. Section 355.110, Regarding Informal Reviews and Formal Appeals. Once the informal review has been submitted, be prepared to provide any additional information that may be requested by PFD staff. Any expense documentation uploaded must be system-generated and presented in spreadsheet format. You will receive an email notification if HHSC PFD staff requires more information. You will have a 14-day window to respond and upload any requested additional information. Failure to do so will result in the report being marked complete by default. According to TAC 355.110D, providers have the right to file a formal appeal against decisions made during an informal review. To initiate this formal appeal process, providers must submit a written request that outlines the basis of their appeal. This written request must clearly state the grounds for the appeal and include a legible copy of the decision made in the informal review. It is important to note that if the informal review request does not comply with TAC 355.110, it cannot be appealed further. The formal appeal process is strictly limited to the issues and documentation that were considered during the informal review. The request must be mailed to Texas Health and Human Services Commission Appeals Division, Mail Code W613 or W615 for CPC only, P.O. Box 1490030, Austin, Texas 787149030, fax 5122315779. Finally, let's establish the communication expectations set by HHSCPFD. Communication between HHSCPFD staff and entity contacts, financial contract holders, and cost report preparers is essential at various stages of the cost report process. These interactions often require the sharing of technical and detailed information, which can lead to misunderstandings. HHSCPFD maintains a strict policy against any form of communication that is unprofessional, inappropriate, or aggressive, emphasizing the importance of respectful dialogue. Should such inappropriate communication occur, HHSCPFD staff reserves the right to cease further interactions and may revoke access to the cost reporting system. Providers are encouraged to address any concerns with the immediate supervisor of the HHSCPFD staff member involved, ensuring that issues are handled appropriately and promptly. This concludes our lesson from Module 20. In Module 22, you will learn about HHSC Rider 32 from the 2026 through 2027 General Appropriations Act, Senate Bill 1, 89th Texas Legislature, Regular Session, 2025, Article 2. This lesson will cover Rider 32 information. The Health and Human Services Commission, HHSC, shall collect information from each Medicaid long-term care provider that provides residential or facility-based services for the purpose of submitting a cost report to determine the profits and losses incurred by each provider, including any non-Medicaid revenues and costs. Providers will submit cost reports to HHSC and include information on assets located in Texas that were owned by the provider's corporation or related business entity during the cost reporting period. Next, we will review the cost report requirement. All providers, except for 24 RCC and CPC, will report, on the biennial cost report, all Medicaid and non-Medicaid assets owned by the business entity or other business components. In the contract verification section of the cost report, providers must review and identify all business components associated with the cost report. Now we will discuss the asset information required on the cost report. HHSC Provider Finance Department PFD will collect the following data on assets owned to determine financial stability: a listing of all land and buildings or improvements located in Texas and owned by the provider's corporation or a related business entity, the fair market value of items described in subsection A1 as they existed on January 1st. Supporting documentation. Providers will be required to provide supporting documentation within the cost report. The following is a list of documents that can support the fair market value on January 1st and asset information: property tax, fair market appraisal document, HUD-1, closing disclosure form, bill of sale or purchase agreement, contract of sale, tax assessment records, purchased loan documentation, independent appraisal. Finally, we will discuss the legislative reports related to Rider 32. HHSC shall report on the data, including the aggregate totals by provider type, the profit and losses reported, and a summary of the real property and assets valuation. HHSC will deliver the report yearly to the Legislative Budget Board, the Lieutenant Governor, the Speaker of the House of Representatives, and the Office of the Governor by December 1st of each even-numbered year. Please contact the HHSC-PFD LTSS Center for Information and Training Team if you have questions regarding Rider 23 and this module by email at pfd-ltss@hhs.texas.gov or by phone at 737-867-7817. By visiting the PFD LTSS webpage, users can access cost report training resources and instructions, as well as important information letters related to this topic. This concludes our lesson for Module 22.